We're looking at the riskier parts of the market. They can't get much better than this.
Technology companies driven by artificial intelligence is going to be where you get your earnings growth this quarter.
On the whole, things are quite nice, but the fact is there are a lot of potholes.
The pullback would be healthy.
With continued clarity on tariffs, we've got a calmer market, hopefully.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday, investors ignoring the drama. As President Donald Trump prepares to visit the Federal Reserve Building, the European Union and the United States are said to be closing in on a trade deal. And big tech earnings are delivering. Alphabet is plowing billions of dollars into AI investments. It's more fuel for a record-breaking rally.
So there used to be questions about how long this investment cycle into AI infrastructure could continue. Some people speculating maybe it was plateauing. Well, wonder no more. Alphabet comes out. Not only did they increase their spending by 11%, but you have discussions around Sundar Pichai saying, if we don't do this, we'll fall behind. If we don't do this, we can't meet our customers' needs. And what you're hearing from around the street is that this AI investment cycle is longer and deeper than most people had expected.
Alphabet's one story, Tesla quite another, down hard in the pre-market. Elon Musk saying this: we probably could have a few rough quarters. Revenues down, vehicles delivered down, average selling price down. The transition from pre-autonomy to post-autonomy is a tricky one.
When it comes to Elon Musk, too, what is happening in policy in Washington is also hurting his business right now. He's concerned about the EV tax credits that have been pulled out with the One Big Beautiful Bill, and then also tariffs on the horizon. They admitted yesterday that not knowing the tariff story, the fact that there are going to be higher tariffs, especially when it comes to China, where everyone is getting their batteries and their raw materials, that is going to really complicate their trajectory. So they're in a tough position right now, and he was honest about that.
Stock is down at the pre-market by 6%. Let's talk about trade. The prospect of a deal between the EU and the US. We played this game yesterday. The bad news is it's 15%. The good news is it's not 30%.
To me, I'm still trying to wrap my head around what's good and what's bad. Because right now I was looking at the ECB, which is going to meet later today, and their expectation was for a 10% baseline tariff. And that was going to slow growth, but not that badly. The worst case scenario was a 20%. Okay, well, we got 15. So is this, okay, it's fine. We've got certainty. Let's all just shrug it off. This is the beginning of yet another negotiation. What's the end point to these negotiations? And that's really my ultimate question. Are these deals true certainty?
Well, these deals, I think, could be a bit fluid. And the Treasury Secretary said that last night, speaking to Fox News, the fact that if they don't like what Japan is doing, say the tariff rate could go up. What I would say, though, is very clear hearing from the president last night, because I was with him at the AI summit. 15 is the new 10. If you think you're getting under 15, you're not. 15 is now the floor. And then the president went on to say that they are close to an agreement with the European Union. He said everyone's going to get between 15 and 50%. And then he said there's over 200 countries. He was talking about countries, some of them he even admitted he hasn't even heard of. And he says it's a lot of deals, quote, even if you're like me, a deal junkie.
Europe in focus a little bit later this morning, 8:15 Eastern time, that ECB decision. 30 minutes later, we'll have a news conference with President Lagarde. In between, jobless claims at 8:30, and just before that, earnings from American Airlines. This morning, futures positive, building on all-time highs. Coming up over the next 60 minutes or so, Andrew Sheets of Morgan Stanley, warning of slower growth still ahead. Ed Mills of Raymond James, as President Trump says countries will face tariffs anywhere from 15 to 50%. And Dan Ives of Wedbush, as Elon Musk is expecting a rough few quarters. We begin this hour with stocks trading at all-time highs. Morgan Stanley's Andrew Sheets warning of a tougher second half, warning of slower growth, stickier inflation, and no Fed rate cuts. Andrew joins us now for more. Andrew, good morning, sir. Stocks at all-time highs, credit spreads incredibly tight. Are you making the case that perhaps second half dynamics won't support these markets?
Yeah, good morning. So I do think investors do need to prepare for what could feel like a very different second half. I think a lot of us are looking at these markets, incredibly strong credit markets, incredibly strong equity markets, and there's a temptation to think, well, maybe tariffs don't matter. Maybe everything that's been happening just kind of doesn't matter in the face of all these other positive forces. But I think what the market kind of needs to deal with is that we haven't really made contact yet with what we think are going to be the main inflationary or growth impacts of those tariffs. And a lot of those are going to come in the second half, not the first half of the year. And so specifically, we're going to get kind of a core PCE number at the end of this month that will show the start of an uptick. I think markets may really start to care about that kind of next month, mid next month, where you get the next CPI number, another uptick of inflation, 2 upticks, that's a trend. And then as you get deeper into the second half of the year, that's when our economists at Morgan Stanley are forecasting growth to continue to decelerate and kind of get down to kind of sub 1% in kind of the fourth quarter of 25, first quarter of 26. So, that's a very different combination than where we've been. And so I think while it's tempting to think markets are kind of resilient in the face of anything, I think they still need to be tested in the face of that changing mix. And that's why I think we could get a little bit of rockiness, not severe rockiness, but a bit of rockiness in the third quarter.
So far this year, Andrew, how much of the bad economic data has been masked by the good investment cycle that we've seen with respect to AI?
Yeah, so I think that is a positive story. And look, you alluded to this, earlier in the show, that the investment story in AI is real and it's going to be significant. I mean, we're forecasting roughly $3 trillion of spending on AI data centers and hardware just through 2028. These are enormous numbers, and there's a lot further to go. But, I also think what's notable is that with a lot of these factors that investors have been focused on, tariffs, immigration, there's a large lag in all of these things. I mean, again, if we look at kind of tariff collections, they've only recently begun to accelerate rapidly. And so, if we think about kind of final private demand within the GDP numbers, that's probably the fairest number. It's not distorted by the big swings in imports and exports. That number has still been running at a pretty healthy kind of 2% type of range in the first and second quarter of this year. It starts to step down a lot in the back half. So again, the AI investment story, that's secular, that's going to continue in the background. But I also think part of the masking has just been in the delay, and that delay is going to start to give way in the second half.
How much, Andrew, when you talk to clients, and this is something of a psychology question, do you feel that people just shrug off what you're talking about, that stagflationary mix that so many people were talking about a couple months ago, saying, look, if you cry wolf again and again, I'm not going to believe you? How much is that kind of what you get met with when you talk to clients?
Yeah, I think that's a huge issue because these issues of higher inflation, slower growth from tariffs, these have been in the conversation now for a while. And I think investors are understandably kind of tired or frustrated of kind of dealing with these issues that month after month kind of continue to be kicked back. And even the non-farm payroll number we think we're getting on August 1st, Morgan Stanley is expecting 140,000 jobs. We're expecting a pretty good number. So something that we think is going to be still showing some resilience. Again, the growth weakness is a little bit delayed. So again, I think investors are understandable of why they're skeptical of this, but we do think that slowdown is coming. And this is, again, where kind of that CPI number is so important. I mean, I think a second straight uptick, that should start to get some attention.
When it comes to AI and that eye-watering number you're talking about for 2028, how much is that dependent on deregulation? Yesterday at the AI Summit said the most important person in the room was not NVIDIA's Jensen Huang, but actually was the EPA administrator when it comes to making sure that they can get these contracts through the U.S. government.
So, yeah, the power side of this is enormous. There's, maybe a 45, gigawatt shortfall of power, over this period of time, over this funding cycle. So, getting the electricity into these plants, that's going to be huge. I think that's the biggest bottleneck we face. We think the water issues are maybe less significant, but the power issues are huge. And there's a big regulatory element of that. There's a big production element of that. And that regulation is also not just federal, it's state, it's local. It's very complex.
So this is going to be a complex environment over the next few years. When you talk about tariffs, I just would love to understand from your point, do you think the administration has conditioned the market to accept these higher rates they're now talking about?
I'm not sure they have, actually, because these higher rates are still pretty new. And I think when we also are listening to commentary from companies, I think companies don't know how long they're solving for the tariff duration. Again, because it's still possible to believe that these tariff rates are still only going to be temporary, that they'll come back down, that this is all kind of part of that art of the deal, that even the 15% rate will only be temporary. So I think that is still a challenge. I think it's the cumulative effect, right? I think the U.S. collected $26 billion of tariffs in the most recent month we have data, which is June. You had $26 billion annualized is over 1% of GDP. That's a big number. Over a given month, it's not that big of a deal. But the more time that goes on, the more this cumulative effect piles up. I think that does have a grinding, larger issue that's going to be felt by companies, felt by consumers. And so, the duration on this stuff matters. And again, I don't know if there's been, we don't think there's been full adjustment. And that's a reason why we do think growth slows down, that there is this cumulative effect of change that we have not seen yet. That's happening on both the tariff side and also on the immigration side of the economy.
Andrew, thoughtful stuff, as always. Andrew Sheets there from Morgan Stanley on the US economy and on global markets. The next test is the economic data. What does the pass-through look like? If we get weaker data, how forgiving will investors be? And does it complicate the easing bias at the Federal Reserve?
And on the contrary side, if you don't see that kind of pain filter into the economic data, how much do people double down on bullishness and then get potentially smacked in the face when some of these potential ramifications come through? I know that sounds really dramatic, but that's kind of what Andrew was talking about.
I'm with you. Morgan Stanley not alone. Goldman Sachs talking about something similar, that these dynamics, the growth inflation mix, will sour in the back half of this year. We'll see.
Yeah, but if you cry wolf too many times, nobody's going to really believe you. And I think that's part of what's going on here, is that the bears have been wrong for so long that people are just saying, stop being so pessimistic. AI will solve everything. And that's sort of the dynamic right now in the market.
We're all massively desensitized. So desensitized that this headline here isn't shaking anyone. The president visiting the Federal Reserve later on today.
No one's really surprised because of this issue. He's almost told the market what he plans to do and conditioned them that he obviously has a problem with Jay Powell. Also, I would say the Treasury Secretary made it very clear that they are just going to let him serve out his term, and they are not in a rush even yet to name someone, to have this idea of a shadow Fed chair. I think a lot of people also, especially on the heels of the Wall Street Journal report last night about Epstein and what's going on at the DOJ, that they view this strictly as a distraction tactic.
So what's the trade? Jordan Rochester will join us a little bit later from Mizuho. He's making the case that just price in more cuts for 26. Forget the games in the theatre, the drama of 25, just price in more rate cuts for 26.
And that's what a lot of people are saying. That's what we heard yesterday from Bank of America as well, from Aditya Bahave, saying essentially whoever they put in the office next year is going to have an inclination to cut rates. Whether that's going to be challenged by some stagflationary type data, I don't know. People aren't even considering that, because ultimately that is going to be a predicating factor for whoever gets that nomination.
If you are just tuning in, welcome to the programme. Equity futures this morning positive by about 1/10% on the S&P 500, following another all-time high at a close yesterday. With an update on stories worldwide with your Bloomberg brief, here's Yahara Anand. Hey, Yahara.
Good morning, John. We're just over a week away from President Trump's August 1st trade deadline. Last night, the president said he would set reciprocal tariffs between 15 and 50% for countries who do not make a deal. The EU and U.S. are moving toward an agreement that would set a 15% rate. Trump said the EU can pay a lower rate if it agrees to open up to American businesses. Meanwhile, shares of Tesla are falling 6% in the pre-market after the EV maker reported second quarter results that missed already lowered Wall Street expectations. Revenue fell 12%, its sharpest decline in a decade. CEO Elon Musk warned of a few rough quarters ahead as Tesla loses EV incentives in the U.S. And on the flip side, Alphabet shares are rising 3.5% in the pre-market after its second quarter sales beat estimates. The company said it's raising capital spending by $10 billion to $85 billion this year, citing rising demand for cloud and AI services. Google is weaving its flagship AI model Gemini into its product portfolio as it confronts competition from both Meta and Microsoft. That's your Bloomberg brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the programme, 15 is the new 10.
We're going to have a very, very simple tariff for some of the countries, a straight, simple tariff of anywhere between 15 and 50%.
Up next, we'll catch up with Ed Mills of Raymond James, live from New York City this morning. Good morning. Check out the euro this morning. Euro dollar 117.48, down by 0.2%. An ECB meeting later on this morning. After cutting borrowing costs by 200 basis points over the last 12 months, The ECB and Christine Lagarde are expected to hit pause at a meeting later today.
Yeah, and if they do, that would be the first pause since its July 2024 meeting. And the big question is going to be, how much further are they going to go? Will they cut again, or are they going to remain on hold for a prolonged period of time?
Expected to remain on hold and then figure out what policy looks like. We're all in the same boat. We're waiting for a deal between the US and the EU. Equity futures positive by about 0.1% on the S&P 500, up a third on the Nasdaq. Under surveillance this morning, 15 is the new 10.
We're going to have a very, very simple tariff for some of the countries. There's so many countries you can't negotiate deals with everyone, so we'll have a straight, simple tariff of anywhere between 15 and 50%. A couple we have 15 because we haven't been getting along with those countries too well, so we just say, let's pay 50, and that's the way it is.
It's the latest this morning. President Donald Trump suggesting tariff rates will not go below 15% as Europe is said to be closing in on a deal ahead of its August 1st deadline. Bloomberg's Akela Gardner joins us now for more. Akela, welcome to the programme. Just how close are we to an agreement between the EU and the US?
Well, we still are not sure exactly how close the U.S. and the EU are to a deal. But as you said, we do know now that the new floor is 15% after President Trump and his top cabinet officials have continued to say that 10% was the floor. That seems to be shifting. But that number is particularly important to note because that is the figure that Japan just secured this week for their tariff deal. They also secured 50% for automobiles, which is a huge question for them. They really wanted to see that tariff go down from 25%. But with the EU still in focus, the president said yesterday that their conversations are very serious. But something that Commerce Secretary Howard Lutnick said in his interview with Annmarie just yesterday is he really touted that $550 billion fund that Japan is now touting for the U.S., an investment fund. They say it's all new capital. And it really shows that they're looking for these big, shiny objects from countries. They want to show that they're securing a deal that, in their eyes, is good for the American people. And that is something that they could be looking from the EU and other countries going forward.
We're slowly getting some clarity on what these trade agreements might look like over the next several months. Where we're not really getting any clarity is the future of Chairman Powell. To have this on the schedule today, Kelly, you've been following it. The president will visit the Federal Reserve. What's the objective of this visit?
Yeah, we've been talking about this visit all week, but we did not know that President Donald Trump was also going to be on the visit. That was a surprise to me. This came in last night that he is expected to visit the Federal Reserve. We knew that his top aides, including his budget director, Russell Vought, were expected to make that visit. Also some other top officials. But now the president is going there. And this is a really interesting contrast because the Federal Reserve, of course, is an independent entity. You do not typically see presidents visit the buildings. And we know that they're looking at the renovation projects. There's been a lot of skepticism about the cost overrun, which they estimate to be about $700 million. But Federal Reserve Chair Jerome Powell has continued to push back to say that they are handling their finances responsibly and push back against these allegations that he is wrongly handling the finances of the Fed.
Akela Gardner, down in Washington. Akela, thank you. To extend the conversation, Ed Mills of Raymond James joins us now for more. Ed Mills, a tour of the Federal Reserve HQ. What's the purpose of this tour?
Well, John, Donald Trump's a builder. He loves a good tour of any construction site. He loves theatrics. He loves to keep this pressure campaign on. I don't think that President Trump is going to fire Jerome Powell, but do they like to keep that pressure on? Do they like to have conversations about who the next Fed chair could be? Absolutely. Do they kind of think that this could potentially get people to focus on what that next Fed chair could do, how dovish they would be, how they could deal with kind of the long-term interest rates that Scott Bessent always talks about, but a little bit of theatrics because he loves theatrics.
I'm envisioning now the president with a hard hat this afternoon at 4 p.m. when he takes that tour. Ed, is it working, though, this jawboning, these tactics when it comes to the Federal Reserve?
Yeah, Annmarie, when I talk to clients at Raymond James, they get concerned about the independence of the Fed. They get concerned that this could have the exact opposite effect. Ultimately, if you saw Jay Powell resign early or you saw him fired, the concern there would be, you'd actually see the long end of the curve blow out a bit. There is a concern already in the market that we just lifted the debt limit. And with the lift of the debt limit in 2023, the last time we used a lot of extraordinary measures, you had the 10-year go up 100 basis points. Now, we're not calling for that this time, but there is concern that there's a bias higher in long-term rates, and to do anything that could affect that in a negative way is not welcome news by this market.
Our colleagues in Washington caught up with Speaker Mike Johnson yesterday, and he said he was disenchanted with the Fed, but he wouldn't say whether or not he thinks the president should fire them. He said it was unclear about the legal authority that the president has to dismiss the Fed. Could that give the market some comfort, given the fact that the Federal Reserve comes with the purview of Congress?
Yeah, I mean, I think what we've seen throughout Jay Powell's term is that he's actually gotten a lot of good relationships built on Capitol Hill. It was actually unusual how well he has developed some of those relationships. And I think that gives him a bit of insulation right now, Annmarie. I do think that if we see coming out of today that Trump calls for an investigation, we already had Bessent call for an investigation last week, that's actually positive news because investigations take time. You always need a verb in Washington, D.C. If you're not going to fire, what else are you going to do? Let's investigate. Let's tour. These other verbs extend out the timeline of his ability to stay there. And then it kind of goes to that next question of who's next? Is it going to be Waller? Is it going to be Warsh? Is it going to be Bessent? Is it going to be Hassard? Those type of conversations is where the next verb goes after we have that quote unquote investigation into what's really going on here.
Ed, in the beginning, people were talking about Fed independence. It seems as though the market's moved on. How much do clients call you and take this seriously versus say, how much is this a distraction technique, as Annmarie was mentioning?
Yeah, Lisa, I do think that the part of the reason why they have moved on is because there's been multiple times where the president's kind of has said that he will not fire Powell and that others in his cabinet, especially the Treasury Secretary, has come out and said that that is not going to happen. He's going to let him play out his term. And the fact that each of the individuals I've mentioned are viewed as credible next Fed chairs. There could be a debate among the group as to kind of who the market would like more and who would be the more traditional one. But we're not seeing candidates so far that are so outside the norm that they say, all right, well, at least once we get through this, who is in that seat was in the kind of lane of normal candidates, and therefore they're okay with this.
Which is a reason why a lot of people are just parking the apprentice, the Fed style, to the side and taking a look at what the tariff rates are and the next policy step. And when it comes to the tariffs, it does seem like people are welcoming this degree of certainty. How much certainty are we getting from the deals that are being announced, given the fact that they're fungible? It seems like they're still in a negotiation process.
Lisa, I thought we were in agreement that this was Love Island, not Apprentice, but we'll move on from there.
Game of Thrones.
But on the,
we can debate that later.
On the tariffs, I do think that there is a lot of folks that are saying, all right, these deals are not real deals, that these are memorandums of understanding. They're kind of easy to kind of come up with in a abstract sense right now. The real work comes later. And therefore, there's an expectation that come August 1st or soon around August 1st, we'll get the vast majority of our main trading partners to sign that MOU, live to fight another day. The U.S.-China relationship, it seems like that August 12th deadline is going to get extended because Bessent is meeting with his counterpart next week. And so to the extent that we've had positive things, even though the bar is being kind of moved once again from that 10 to 15, as long as it doesn't seem as if something completely unexpected comes, they're okay. If there's a bit of nervousness out there, though, Lisa, is the sectoral tariffs. Most of my week this week has been answering questions about what's happening with semiconductors because they're at 52-week highs, and a unexpected outcome there is what could rattle the market.
Nothing beats a trashy UK season of Love Island. Ed, thank you, sir. Ed Mills.
That was your takeaway?
There's no way you watch Love Island.
Of course I do.
Oh, you know he watches Love Island.
Love that stuff.
The British version or the American version?
The British version.
All of them, probably.
So you switch off from financial markets and everything going on here.
But do you? That's the question.
Up next, I'll get dialed in. Dan Ives of Wedbush as Elon Musk warns of a hard year ahead for Tesla. 3 days of gains on the S&P 500. Incidentally, the longest daily winning streak of the month so far. Equity futures this morning just about positive on the S&P. On the Nasdaq, up by 0.25%. Earnings validating the rally of the last several months. Beat and raise has been a theme over the past few weeks. American Airlines out a little bit later. The airlines, for me, very interesting because the airlines were the first to warn and the first to signal the all clear over the last few months.
Yeah, although which airlines? And this actually is going to get increasingly important. We heard from Delta, we heard from United, a raise and a beat, and the sense that there was this resurgence of customer demand. Southwest, not so much. And how much is this a tale of two different customer bases?
Let's get some single names for you. Anna, look at some of that. 3 hours away from the opening bell with your morning movers. Here's Danny Berger. Hey, Danny.
Hey, John. Yeah, some of these big tech names impossible to avoid this morning. Alphabet being one of them, reporting after the bell. It is getting that AI demand that is exciting investors, despite the fact it talked about $85 billion in capital expenditures, $10 billion more than it had forecast previously. First shares dipped post-market off of that. But considering the type of demand it's getting and it needs to spend that much, investors are okay rewarding it. On the other side of things, we have Tesla this morning. Those shares falling quite a bit, just under 6%. The quarter itself was really difficult. It was the worst revenue in over a decade in terms of growth there and dropping there. And then it was also a rough quarters ahead that Elon Musk warns as he tried to frame this as a company in transition from EVs to robo-taxis. I know you're speaking to Dan Ives in just a moment about that, so I wore my brightest jacket in honor of that. Finally, wrapping things up with Chipotle, they also reported earnings after the bell yesterday. Easily the worst performer in the S&P pre-market, down 10%. They cut their annual outlook for a second time, something that's very rare or had been rare for Chipotle. They said it's economic anxiety. The CEO saying that customers want value over what he called freshness and quality. He says they're not going to offer any discounted type offerings. Instead, they just need to do a better job communicating that Chipotle meals are a good deal, John.
Danny, thank you. Appreciate the update. More from Danny in the next hour. On a radar this morning, President Donald Trump declaring countries will face tariff rates between 15 and 50% as countries race to make agreements ahead of his August 1st deadline.
Yes, I keep coming back to it. People are rallying around this idea of certainty, even though it isn't the 10% that we initially thought was the floor. My ultimate question is, how much certainty do we actually have, given the fact that you've heard a number of trading partners that already have deals come out and say, we're looking for a little bit of a better rate. And you have the president saying, well, if they don't behave well, we're going to raise that tariff rate. So, again, how much certainty have we really gotten?
There's not a lot of certainty because there's going to be uncertainty throughout the entire administration. We are 6 months in and we have another 3.5 years to go. What I will say, though, it is clear that no one is getting under 15%. Really, no one, in terms of how I viewed yesterday's discussions with a number of cabinet officials and also other people at the White House. Also, when the European Union comes out saying that they have these lists and they're going to go for a 30% retaliatory rate on the United States if there's no deal in place, basically everyone in Washington is shrugging this off and they're just like, yeah, whatever. They have to say this. They're taking cues from us. It's a negotiating tactic.
And if you don't strike a deal, maybe the floor comes up. If you wait, maybe the floor comes up from 15 to 20.
Yeah. At what point does the market care? Here's the ultimate question. Has the market really moved on, and is it legitimate to just move on from this idea? Or could we see something that actually rattles people again and gets a sense of a trade war brewing once more?
Got to see it in the data. We've talked about this over the past few weeks. Don't see it in the earnings in a big way. Seen some great earnings, seen some raises to guidance as well from some cyclical names. When you start to see it in the data, if you see it in the data, then we've got a different story.
And then all of a sudden 15% becomes a little bit more punitive. I'm very curious about what the ECB says about this rate and how they bake that into their growth estimates for the region and what that means for their projections going forward.
The ECB meeting today, that concludes at 8:15 Eastern Time. Let's turn to this. Another central bank. President Donald Trump making a rare visit to the Federal Reserve this afternoon. He'll tour the construction site, being criticized for cost overruns. Trump's visit marks the first of its kind in nearly 2 decades.
You don't normally see this. And we did know, to Kayla Gardner's point earlier, we did know that administrative officials were going to head over to the Fed today. We just didn't know the President of the United States was going to be joining them. I like what Ed Mills was saying. This is someone who, loves theater, loves a little bit of drama. Also, public confidence in a recent Gallup survey shows that the chairman, Federal Reserve, Jerome Powell, is at a low right now. So maybe the president, maybe it's a distraction tactic, but at least he's leaning into, I think politically, what they would say, maybe where the American people are. And he could say, you guys don't trust him, I don't either, and I'm going to go take a look at this renovation myself.
The president's got expensive taste. He might make the case to spend more. You never know.
I was actually wondering that. Is he going to say, I don't like the marble, I want better marble? Here, a little history lesson.
Put some gold on this.
Exactly. I would like gold plating, and I'd like some angels. I am curious about just the history here. I was looking, 2006, George W. went to go visit and go to the then Fed chair's swearing-in ceremony of Ben Bernanke. Before that, Gerald Ford, 1975. Franklin Roosevelt in 1937. Those are the previous visits from presidents to Fed officials.
But those visits, the tone was different. I'm going to see the swearing in. I am welcoming this person. I am excited about this Federal Reserve and independence. This is about, I don't like what you're doing. And even you have senators now calling for this investigation into the renovations. The renovations are above budget. But at the same time, this is not going to be one of those George W. Bush exciting visits. This is going to be something the president is going to, put the Howard hat on and say, this is terrible.
They weren't real estate developers. He is.
Yeah, exactly.
I love this later
Big condos.
This afternoon. In the building.
In the building.
Yes,
pay for the renovations.
Lease them out to Fed governors.
Exactly.
Who knows?
Save money.
Let's get to earnings. Alphabet reporting strong AI demand alongside surging capital spending. The tech giant raising its capex forecast for the year by $10 billion to $85 billion.
And they're not done. The commentary was saying that they're going to keep raising next year because ultimately, if they don't, they're not going to keep up with customer demand. On top of that, they have to offer compensation that also was significantly higher than expected. Why? Well, thank you, Meta and Mark Zuckerberg, and how much they're paying people to get talent on board. They're increasing their compensation packages over at Google as well because they need the top tier talent. This just shows it is a war for talent. It is a war for prowess in the AI world, and it is not going away.
Almost a year today. The risk of underinvesting is dramatically greater than the risk of overinvesting for us here. The Alphabet CEO, 12 months ago.
And it seems like that hasn't changed. And I will just say, OpenAI, ChatGPT, how much is that the threat that keeps up Sundar Pichai at night? Because ultimately that is an existential threat to their business model at a time where they're still highly dependent on advertising revenues.
That stock is up by more than 3%. Let's stick with the Mag 7. Tesla CEO Elon Musk warning of some rough times ahead after one of the automaker's worst quarters in over a decade. Dan Ives of Wedbush is the biggest Tesla bull on the street with a price target of 500 and an outperform rating. Dan joins us now for more. Dan, good morning.
Great to be here.
Revenue down 12%, vehicles delivered down, average selling price down, and yet you're at $500. Tell me why.
Yeah, I mean, look, the quarter itself, nothing to write home about. But I mean, our view, it's about autonomous robotics. AI is the future for Tesla. So to me, yeah, it's a rough few quarters ahead. But I believe autonomous, we are in the beginning. What's going to be $1 trillion valuation alone for Tesla. So that's why I don't get so concerned when we talk about deliveries, which actually were kind of in line. When we look at what's going to happen in the second half, the story here, when it comes to physical AI, two best ones out there, it's going to be Tesla and NVIDIA.
Moving from a pre-autonomy to a post-autonomy world, did he do enough on the call last night to convince investors that it's going to be smooth sailing?
Look, I mean, obviously the call, definitely some could have criticism in terms of promising so much. Look, my view is if 20 to 30% of what he promised you see in the next year, this is a stock that's up 70, 80% from here. So that's why when I look at Tesla, I don't focus, and we've talked about it so much in the show over the years, I don't focus near-term deliveries, what that means in terms of, EV tax credits. This is an autonomous robotics store. And I think, look, the AI revolution, as we saw from Alphabet, I mean, we are just in the early days of this playing out.
Maybe I'm Chicken Little, but I was looking at this press conference. I was reading this and I was thinking, this is a disaster. I mean, essentially, this was a dream stock, and suddenly they're talking about tax credits and things of that nature. They used to talk about an affordable vehicle. Now they're talking about a stripped-down Model Y that doesn't sound that sexy at all, and they're going to expedite production of other vehicles and put that on hold. What would it take for you to get bearish?
Yeah, look, I mean, you bring up great points, and that will be the bearish points. And when it comes to the affordable next vehicle, is that just going to be a stripped-down version? Look, Lisa, my view is that it comes down to like robotaxi. If you're in 25 cities in the next year and you actually start to get volume production of Optimus when it comes to robotics, I think 90% of the future value is going to be in the AI story, not on the actual deliveries in terms of cars out there. You have 10 million vehicles in terms of Teslas out there. It's all about the data. And I believe the big thing is going to be at the shareholder meeting where they'll have a significant investment in XAI. And I think that's where you get more of a wartime CEO in Musk. And I think that's really going to be the difference.
Were you satisfied by his answers about XAI, about the investments there, the crossover with Tesla? Because there was a lot of ambiguity. Yeah. And he was asked that directly, and he wasn't able to explain that connection and how it really does rebound over, other than some people who are in this industry don't really want to work at a car company. I want to offer them an opportunity to.
Yeah, I wouldn't say that conference call is not, you wouldn't put him in the Neary Hall of Fame, that conference call, okay? But again, we know with Musk, it's never going to be, it's not going to be Microsoft-like. But my view is, and we've talked about it, like the board, they need to get them 25% voting. I think that's key. That starts what's going to be a significant investment in XAI. But we've said also, are there guardrails there that they need to put on? You've seen them become less political since the July 4th third party, too. So I think, look, you want to see them less focused on that, more focused on being CEO, because it comes down to the biggest asset for Tesla is Musk.
The press secretary yesterday was asked, does the president support federal agencies contracting with Elon Musk's AI company? Her answer, I don't think so. No. Can he do this without contracts?
Look, I think, but then it comes down, look at Grok. I mean, when it comes to Grok, and a huge part of the DoD deal, look, the reality is that Trump administration could say what they're going to say, but they need Musk. Of course, they need Jensen. I mean, they're going to need leaders when it comes to, of what this AI revolution. I think, look, that's the reality. And I do think at one point you'll start to see them, I wouldn't say necessarily become friends again, but sort of mend fences given what Musk needs to do going forward.
Well, Elon Musk, Sam Altman were not called out yesterday when the president was giving shout outs at this AI summit. Is Jensen Huang the new first buddy?
Look, he's at the cool kids table. I mean, right now, if you look where Jensen is, he is the first buddy for Trump. Because
he's almost running policy, Dan.
Look, and the reality is there's one chip in the world fueling the AI revolution. And that's why when it comes to the Middle East trip, who's to the right of him? Jensen. When it comes to anything, when it comes to China negotiation, the biggest poker chip that you have is NVIDIA. I mean, when it comes to, so first buddy is wearing a black leather jacket, his name is Jensen.
Final word, Alphabet. What did you think of the numbers?
I thought this was as bullish as you could see in terms of the actual numbers from search, from YouTube. And this is no longer an Alphabet in the corners crying. This is one coming out being we're on the offense.
Do you think they can make the transition from that ad model that's dominated the last several decades in Silicon Valley? We can make the transition away from that?
I think it's going to be a renaissance for Alphabet. I believe from a large cap perspective, it's one of the best risk rewards out there. That's why it's a table pounder. We went 225 in the price target. And look, haters hate on this, and I get it. But the bears in hibernation mode, there was nothing on that call that they're going to grasp onto. And I want to see them increase CapEx. It's an arms race for that right now in AI. You want to see them in the left lane.
The good news is the market's willing to support them, Bremo, that the stock is up off the back of this CapEx boost and it's not down, because then they'd have very different problems.
Well, initially it was down, and that was interesting because people had the knee-jerk reaction of stop spending so much before you can give us a sense of how you're going to monetize it. But as he spoke and he talked about customer demand to change, right now I am ChatGPTing, is Google search in its decline? And I will let you know what it says.
But I'd also say the bears, when they're in hibernation mode in the caves, they can find AI in the spreadsheets. And that's part of I think how they've missed so much of this AI revolution. Look, get the popcorn out. This is just a precursor of what's going to be a bullish tech earning. Microsoft, Meta, Palantir, and others.
Dan Ives of Wedbush. Dan, appreciate it.
Great to be here.
What did ChatGPT say?
Yes, there's a strong case to be made
Shocker.
that Google search is in a period of noticeable
Exactly.
decline. Not in usage necessarily, but in quality, user trust, and effectiveness.
Is this the future of this program? Is this what we're going to be doing?
Hopefully not. We're going to move on.
Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara. Hey, Yahara.
Hi, John. President Trump signed executive orders to boost AI development in the U.S. by loosening regulations and growing power supplies for data centers. Measures will address energy and permit issues for infrastructure, the promotion of AI exports, and a call for models procured by the government to be both neutral and unbiased. Trump says the U.S. will lead the world in AI. Meanwhile, Deutsche Bank shares are rising 7.5% in Frankfurt to the highest level in a decade. The German bank reported better than expected trading results, mirroring the strength we saw across Wall Street. CEO Christian Sewing says the results put the bank on track to meet its targets for the year. And back here in the U.S., IBM shares are falling 5.5% after the company reported weaker than expected sales in its software segment. An area central to its long-term growth strategy. Sales for the unit grew nearly 10% year on year to about $7.4 billion, but that was significantly lower than what analysts were expecting. That's your Bloomberg Brief. John?
Hey, Yahara, thank you. More from Yahara in the next hour. Up next on the program, taking the fight to the Fed.
Why in the world do we have such a high interest rate? It's got to be cut. Donald Trump is absolutely right. It's got to be cut. This guy's got to go. He should either resign or be replaced.
Up next, Jordan Rochester of Mizuho, live from New York City. You're watching Bloomberg TV. Record highs coming into Thursday. Equity futures just about unchanged this morning on the S&P 500. Positive on the Nasdaq, up by 0.25%. Under surveillance this morning, taking the fight to the Fed.
We are the most important country in the world with the greatest economy in the world. Why in the world do we have such a high interest rate? It's got to be cut. Donald Trump is absolutely right. It's got to be cut. This guy's got to go. He should either resign or be replaced. And we've got to have rates lower.
Here's the latest this morning. President Donald Trump preparing to visit the Federal Reserve as Commerce Secretary Howard Lutnick calls on Chair Powell to resign or be replaced. Jordan Rochester of Mizuho writing the following. That's a tale risk markets can't ignore. It reinforces our view that more rate cuts will be priced into 2026. Jordan joins us now for more. Jordan, welcome, sir. Let's talk about market pricing, what the Fed's projecting, implied by the median dot for 26, and where you think things will be a year from now.
Indeed. Well, John, good morning. What you can see in terms of the numbers, they've got 2 cuts for this year, more cuts for next year. For us, the view from Mizuho, John, is actually the risks are to no cuts this year as long as Powell stays in place. So that's why it's a key part of that story. And so we'd like to trade Z5, Z6 flatteners, which basically says price out cuts this year, price in more cuts next year. Whoever will be at the Fed following Trump's change in Fed chair when Powell does step down will be more dovish and lead the direction of markets that way.
So, Jordan, push that through foreign exchange. How does that shape a short-term and medium-term view for the US dollar?
Well, we've had pretty significant sell-off in the dollar so far year to date, thanks to Liberation Day, the FX hedging flows, the European Renaissance trade with Germany. So we're going a bit sideways in the dollar more recently, but I think, John, there's tactical short dollar yen and long euro dollar trades will work. The view from us is we get to 122 in euro dollar by year end, 138 in dollar yen by year end. I think the dollar yen trade of the two is better. Euro's been a bit more exposed to tactical views, where yen had a bit of an unwind in the long yen trade over the past 2 weeks. We're starting to get a bit more yen strength more recently.
Jordan, how do you factor in some of the AI discussions and the strength that's been really on the heels of that we've seen in the economic data as playing into this? The idea that, sure, de-dollarization makes sense when you take a look at monetary policy, but not if you're trading off the relative strength of various economies.
Indeed, the AI capex could be something close to 2% of US GDP. It's quite incredible, the numbers that you see from AI, capital spending expectations. So that actually argues for growth to hold up better. Despite all the fears of what Liberation Day means for corporates and lower investment intentions you got from that, the AI theme has kicked back in, especially with the US administration relaxing their H2O export restrictions. So, Lisa, in answer to your question, it means US exceptionalism could come back, and this whole sell US theme, we call it the de-dollarization theme because some people simplified it to sell America, and for us that was just too simple of a theme and not true. The US has a dynamic economy, a strong labor market, and it will outperform a lot of peers.
At this point, we're going to hear from the ECB later this morning. Potentially, we could hear their projections for growth on the heels of the tariff rate that is being talked about, the idea that it's a 15% floor, not 10%. How much does that impact the growth trajectory of a region that's already had a lot of optimism baked in?
They had a lot of optimism baked in, a bit of a jammy dodger in terms of they looked at their forecasts. They had the fiscal from Germany fully in their numbers, but from the tariffs, they didn't really put in the more severe scenarios that Donald Trump was throwing out there. So at this press conference today, it'll be interesting to see if Lagarde reflects that. We won't have an update of those numbers in the forecast because that only comes at the September meeting. We won't get them in paper, but I suspect she'll have to say, actually, our base case, which was 10%, could be more like 15 or closer to the severe scenario that the ECB had at 20. But I'd like to remind everybody, Donald Trump is actually saying it could be 30. So the ECB needs to weight their forecast a bit more on these tariff impacts. You had a 0.7% hit to GDP between the severe and the baseline expectation for the ECB. It will lower their CPI forecast perhaps by 0.1 to 0.2. So it's not too severe for their inflation forecast, but it can mean quite a lot for their GDP.
Jordan, I'm just going to translate just briefly. Give me a second. Do you guys know what a jammy dodger is?
No, but I assumed that it was something very significant.
What does it sound like to you? What do you think it is?
Jammy dodger?
Yeah, what do you think that is?
A jammy dodger sounds like a party at, backyard barbecue.
It's a biscuit. It's a biscuit. But it also means
British people.
It's slang for getting lucky.
Oh, what is it? Jammy dodger?
Jammy dodger.
So the opposite of sticky wicket.
Possibly. Okay, Jordan, let's continue the conversation. Let's talk about dollar yen. There's a segue. Let's talk about dollar yen. Dollar yen this week, what's more important for Japan? The trade agreement or the future of the Japanese Prime Minister? And with the future of the Japanese Prime Minister in mind, just how wide are the range of outcomes for fiscal policy?
Number one, it's the trade deal, John, because that's fact. We know what the trade deal is. We know it's a big positive surprise for Japanese autos. I don't think anyone really expected the Japanese to get as lucky as they did in getting a 15%. I say lucky, it's still worse than what they had before. But the UK was the only good example of getting close to 10. And the UK exports way less autos to the US than Japan, a factor of 12 times less than Japan. So it's a big deal for Japanese corporates, especially in the auto sector. And then when it comes to the actual leadership of Japan, that's the unknown. We don't know if Ishiba is going to resign. The speculation is rife that he will. The sort of polymarket projections, the sort of betting odds were close to 80% probability he will step down this year. And if that were to happen, then, John, it opens up all these tail risk scenarios. But we don't know who will be the front runner for that leadership nomination. And rule one of Japan politics is don't assume you'll know who wins. Because I remember being quite shocked when Ishiba won last time round. So let's see who comes to the fore there. And if you get Shiba being replaced by a dove, that could be a big thing for the long end in Japan. And that is the big story for later this year.
Jordan, appreciate it. Just make a note next time you speak to US clients. No idea. Jordan Rochester of Mizuho. Jordan, thank you, sir.
You just taught us all.
Appreciate it.
I mean, we all now know, and I've actually been looking at it.
Been researching biscuits.
They look very pretty. Yeah, they do. They're like Linzer tarts.
Kind of things that you like when you're a kid. Anyway, his view on the Federal Reserve. Price out 25, price in more for 26.
And this seems to be increasingly consensus. I mean, we heard this yesterday from Aditya Bahave of Bank of America, who sees no cuts this year, but potentially 100 basis points of cuts next year. Why? Because essentially whoever comes into the Fed will have an inclination to cut.
Let's close out this segment. Up next on the programme. What was that? We'll catch up with Aaron Kennon of Clear Harbour.
You did that.
Libby Cantrill of PIMCO. I was just wondering. I was trying to translate.
Oh, yeah.
He said it, and I saw you being like, I've got no idea
and I was
what
laughing, and I was
is.
laughing because you reacted, and I knew that I did not know.
And then Zero Bance over there starts talking about sticky wickets. Conversation killer. The second hour of Bloomberg Surveillance. Up next.
We could continue to see threats of tariffs.
There's a long list of scenarios as to how tariffs get better and a very short list as to how they get worse.
We're in a little bit of a purgatory on negotiated trade deals.
I do think we're going to get more deals in the coming weeks.
The deadline is serious. The market should cue to this. Trading partners should cue to this.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Everyone knows what Zero Bance is.
No.
Like no banter.
We're going to start on this.
Zero bants. No banter.
Banter is a British word as well.
But doesn't that translate now? I think people understand what banter
is now. That does translate. I mean, yes, but I think I'm going to stay out of this.
No banter.
I think I'm going to. Yeah, I'm going to definitely stay.
You're on this show.
Welcome to New York.
Zero bants.
Let's move on.
Ask the audience.
Your scores this morning look like this. Equity futures on the S&P. Unchanged. Record highs at a close yesterday on the Nasdaq, up by around about 0.3%. Later this morning, attention on a different central bank, the ECB decision, 8:15 Eastern time, and then some economic data, 8:30 jobless claims. We're starting to get a feel for the tariff rates. How well understood of the consequences.
Yeah, and how much patience will people have before they can really just say we're not going to see that weakness? It really has been a chicken little market where people have said that any kind of tariff rate, even a 10% tariff rate, would cause a slowdown in growth. Now you have 15% floor, and people are saying we can look through that. At what point does the data really come to surprise?
Get that economic data at 8:30 Eastern Time. Look out for jobless claims. We might get a deal as well between the US and the EU. Lisa said it yesterday. 15 is the new 10, and it certainly feels that way in the last 24 hours.
Absolutely, and they really only have a week to go when it comes to trying to finalize this deal with the European Union. They're going to have a tough few days ahead because, remember, Treasury Secretary Scott Bessent, Howard Lutnick, the Commerce Secretary, are going to Stockholm to meet with their Chinese counterparts, so they need to really wrap up the European Union trade negotiations basically in principle before Monday. It's very obvious, though. The European Union, which a few weeks ago was willing to eat and tolerate a 10% tariff level, really focused a little bit more on the sectoral tariff levels, are now going to have to eat and suck up 15% because that's where this administration is with Japan, and they're not getting a better deal than Japan.
The White House focused on something else later on this afternoon. The Federal Reserve, the president, said to take a foot tour of the renovations. And this is the kind of headline this president would like to see. This from Turkey. Cutting the one-week repo rate by 300 basis points. That's the kind of headline the president wants, right?
How much are banks actually looking around to see who's traded in Turkey to try to bring them on board so that they can understand better the dynamic? This is a question. At what point is this too much? And at what point do you get the opposite ramification of what you're hoping for, which is longer-term rates going up? Look, the market isn't taking this that seriously because Scott Bessent came out and said we're not in a rush. And I think that his conversation with you put to bed a lot of the concerns that the pomp and circumstance of putting on a hard hat and going and commenting on the marble won't necessarily do.
The pressure is going to keep on building. Let's talk about the earnings so far. We'll get to Alphabet and Tesla a little bit later in the hour. American Airlines just dropping. We've heard from Delta. We've heard from United. They're all reinstating guidance and talking about a better second half.
Yeah, and American Air also reinstated full-year guidance. However, it sees its full-year guidance as being either down 20 cents to up 80 cents, and the expectation had been for guidance about 72 cents a share. So here's the question. How high is the bar for other airlines to meet? And given the fact that there was a really optimistic tilt to what we heard from Delta, affirming up, from United saying that our estimates right now are conservative, how much is American Air now challenged to show why it is not seeing that type of strength, even though we all were surprised by some of that really positive commentary coming out of the other majors?
Stock is down by close to 3% in the pre-market. Futures are doing okay, just about positive here by close to 0.1%. Coming up this hour, we'll catch up with Aaron Kennon of Clear Harbor Asset Management following another record high. We'll speak to Libby Cantrill of PIMCO on the latest trade threats out of Washington, and Chris Caso of Wolfe Research on President Trump's AI plan. We begin this hour with stocks on a 3-day winning streak. Aaron Kennon of Clear Harbor Asset Management writing the Magnificent Seven are expected to grow about 15%. Though notably, this is less than half the growth rate seen in full year 2024. Aaron joins us now for more. Aaron, welcome to the program, sir. Is that you pushing back against some of the euphoria?
No, I actually think it's maybe an argument for the broadening that we're seeing in the market. You know, going to this year, we were writing about how it was maybe going to be a bit easier for the sort of 493 stocks outside the Mag 7 to play a little bit of catch up in 2025. Now, equal weight S&Ps is lagging just by about 90 basis points year to date. I think the S&P's up, call it 8.99%, and equal weight's up, call it 8.1. So, you know, they're moving along more in sync. I think it speaks to the broadening of the market. I think the tariff debate and the reshoring of capital and manufacturing probably will augur well in the back half of the year for maybe mid-cap, small-cap. And in fact, we're already seeing sectors in the United States, which typically over the last couple of years have underperformed that tech run, like industrials and utilities, really perform quite well this year. I think industrials are the most positive performing sector on the year for the S&P.
Meanwhile, the NASDAQ just posted its 63rd consecutive day above its 20-day moving average, which is the longest streak going back to 1999. We hear these types of measurements, 1999, 2000. Does that kind of comparison worry you, that maybe things are getting just a bit ahead of their skis, even as you see potential positivity under the hood?
Well, always a little concern when one sector, in this case technology, is such an overwhelming force in the performance of the market. Lisa, but if you look at forward multiples, yes, they're extended and they're sort of top decile, but relative to where we were during the dot-com era. And if you looked at just sort of the attention to revenue during dot-com versus the attention to earnings and underlying fundamentals, I think we're sort of in a different regime here as it pertains to where we are in the cycle. And I think there's also sort of a trickle-down effect, right? So we're looking at artificial intelligence, and of course that has an immediate impact on technology, but it's having an impact on utilities, on industrials. We're thinking about electrification. Where's the next electron going to come from? Nuclear takes 10 plus years to come online, if it can even be approved. So where are we going to find that? Is it going to be solar and battery support behind it? So there's just a lot going on, I think, in a positive way that is a different setup than we saw in the late 1999s.
We say every single day, Aaron, that the economy is not the market's not the economy. What you're talking about is very much the market and sort of the optimism of the investment in AI that might be felt in the economy in a very real sense, maybe a couple years out. In the near term, you expect there to be some turbulence coming from the tariff rates and potentially a slowdown in growth. Does it matter if we see that slowdown in that economic data for the rally that we're seeing in a market that's looking beyond?
Yeah, it's really interesting. I mean, I think there are a lot of big questions out there as it pertains to this rally, as it pertains to AI. We believe it's going to ultimately accrue to probably strong supporting margins, maybe even growing margins. But we think there will be disintermediation in the employment market. So from an economic perspective, you could see areas within the economy, both sort of less skilled as well as highly skilled, that become soft from an employment perspective, while we're seeing earnings continue to move in a very positive direction. That's a political challenge for sure, but it could accrue still positively to the market.
Not just a political challenge. What does the Fed do with that type of data?
Yeah, it's challenging, Annmarie. I mean, I think at the end of the day, the question the Fed has to do, which is, I think, where they're keeping their eye on the ball. They have a mission and mandate. There's a political conundrum that the Fed faces. Right now, they're damned if they do cut. They're damned if they don't cut. Yet they're keeping their eye on the North Star. And I think as long as they continue to do that, they'll be in good stead. But certainly just a lot of noise around that. I do think if you look at the inflation pressures of late on the margin, the last CPI report, it was on the good side. And it's not clear to me that raising or cutting rates is going to have any impact really on the good side. Those are, food products, gasoline, transportation, things like that. It's more on the service side. So if we saw inflation on the service side, I think it would prompt the Fed to make an even stronger argument that they need to hold for longer.
Well, politics is definitely going to be at the Fed's front door today when the president personally heads over to the Federal Reserve at 4 p.m. later this afternoon. Why is the market just shrugging this off?
It's a good question. I mean, I think at the end of the day, it seems clear that Powell will remain in place until the end of his term. And I think the market may be slightly unsettled. I think observers are perhaps, I guess some are jeering, some are cheering. But I think the consensus now is that Powell will maintain his job. But I find it somewhat ironic, too, that we have a building cost overrun of $2.5 billion at the Fed, and yet we don't have a politician in Washington that cares about the 2026 expected deficit of $1.8 trillion. I guess it's where we are in the political atmosphere and environment right now. It's somewhat unfortunate, in my opinion.
Aaron Kennon of Clear Harbor Asset Management. Aaron, appreciate it. To Aaron's point, if reckless spending was going to keep people out of a job in Washington, nobody would have a job in Washington, would they?
Look, I think that nobody's parsing through all of these details right now. Yes, you are correct. Right now, it seems kind of comical or light to think about $2.4 billion of a renovation that was up from some $1.9 billion back in 2019 when you're talking about, $3.5 trillion hole in the budget deficit.
Trump wants also options just on the table, and he is just trying to undermine at the end of the day the Fed chair's credibility, even if he decides he's not going to fire them. Part of that is because also I'm really struck by this Gallup poll about how the Fed chair is at a low when it comes to confidence with the American people. And Trump is just needling at that a little bit. And today's performance will be part of that.
The pressure keeps building. Speaking of pressure, look at this from the Financial Times. At least $1 billion worth of NVIDIA's advanced artificial intelligence processors were shipped to China in the 3 months after Donald Trump tightened chip export controls. That dropping from the Financial Times just moments ago.
So this is concerning if, especially, that China's getting their hands on these high advanced chips that the United States was really having these export controls and trying to hold on to. My question, though, here, seeing the dynamic play out in person between Jensen Huang and the president yesterday on the trip to the Middle East, was the administration aware of this and they're sort of turning a blind eye? Jensen Huang has been having these conversations with the president, and he is really the reason why they decided to make this U-turn when it comes to the H20 chips. But if not, potentially, this is going to be meaning Jensen Huang is going to get at the crosshairs of this administration.
It also goes to the whole idea of transshipping and transnational interference and exactly where these chips are going through, because this would be the B200 chip. This isn't the H20 chip. And this actually speaks to what actually went into the DeepSeek moment. And that will go to a lot of questions that people have about how advanced they've gotten and is it on the heels of U.S. technology.
Remember that phrase that came out of NVIDIA at the time, export compliant? Was it? Was it export compliant?
This is a great question. And how is it going to be enforced at a time where there's a lot of fungibility and a lot of moving parts on the rules side of things?
Stock is up at a pre-market by about 1 full percentage point. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahira. Hey, Yahira.
Hi, John. We start with some other NVIDIA news. President Trump said he considered breaking up the company to increase competition in AI chips, but changed his mind because it would be hard, according to him. At the White House AI Summit, Trump praised CEO Jensen Huang, while Huang commended the president's AI approach, saying America's unique advantage that no other country can have is President Trump. Meanwhile, Treasury Secretary Scott Bessent says he plans to bring up the Microsoft SharePoint hack with Chinese officials when they meet in Stockholm next week. Cybersecurity firm Securities says the flaw in Microsoft's SharePoint software hit 400 global organizations, including both U.S. nuclear and health agencies. Microsoft blames Chinese state-backed hackers. And you talked about this one earlier. American Airlines shares are falling 3.8% in the pre-market. The company reported second quarter earnings that beat analyst estimates, and it also reinstated its full-year guidance. But it said possible scenarios range from an adjusted loss of 20 cents a share to a profit of as much as 80 cents. American also forecasts a third quarter loss exceeding analyst estimates. That's your Bloomberg Brief. John?
Yahira, thank you. More from Yahira in about 30 minutes' time. Up next, 15 is the new 10.
We're going to have a very, very simple tariff for some of the countries, a straight, simple tariff of anywhere between 15 and 50%.
Up next, Libby Cantrill of PIMCO, live from New York City this morning. Good morning. Equities just about positive by 0.1% on the S&P 500 after closing at another record high in yesterday's session, up by a third this morning on the Nasdaq. Check out the euro 60 minutes from now, call it 59. We'll hear from the ECB, looking for them to hit pause after cutting interest rates by hundreds of basis points over the last 12 months. What's 17.50 on euro dollar?
Yeah, and how much do they indicate that they are ready to pick up rate cutting at some point with one more rate cut? That really is going to be the question. The other question I have is, how do they project out some sort of growth trajectory now with 15% being the floor for tariffs, not the 10% that they had baked in as their base case?
Do they push back against some of that euro strength as well, I wonder?
Yeah. Is it becoming increasingly complicated? Wasn't that the word that they used?
What they usually do, if you're the ECB president, you say something like, we don't target foreign exchange, but it has implications for our price stability mandate. That's how you navigate that issue.
Thank you. Are you writing
and
your
I imagine
scripts?
that maybe they'll do a version of that later on. This afternoon.
We heard from them before saying it's getting complicated once it reaches 120. Well, we're getting pretty close. And if you look at the targets, what, Jordan Rochester, 122?
Yep.
There we are.
117.50 on euro dollar. Under surveillance this morning, as Lisa said, 15 is the new 10.
We're going to have a very, very simple tariff for some of the countries. Have so many countries you can't negotiate deals with everyone. So we'll have a straight, simple tariff of anywhere between 15 and 50%. A couple we have 15 because we haven't been getting along with those countries too well. So we just say, let's pay 50. And that's the way it is.
It's the latest this morning. President Donald Trump suggesting tariff rates will not go below 15% as the EU is said to be inching towards a trade agreement ahead of the August 1st deadline. Bloomberg's Akela Gada joins us now for more. Akela, welcome back to the programme. Just where will we be in a few weeks' time?
Well, it seems like the goalpost is moving regardless. We're seeing President Trump now say the floor is now 15%. That's up from 10%. But we understand that the EU, which is still a trade deal that we're waiting on here, is inching closer to a deal that would see them at that 15% level, including for automobiles. That's down from 30%, a tariff that Trump threatened not too long ago. And they badly want to secure this before August 1st, which is the day that the administration says that they will impose tariffs and start collecting that revenue. But the real caution here is this comes all down to President Donald Trump, who's the ultimate decision maker. He is hard to predict when it comes to which way he will go. He has also been incredibly critical of the EU and its relationship with the U.S. when it comes to trade. So we're going to have to see if he's okay with, again, this floor level. But the EU is preparing countermeasures in case they cannot reach a deal with the U.S. We knew that this is something that they threatened back in April when the U.S. first imposed these reciprocal tariffs. And those could target American cars, Boeing, bourbon, whiskey, some really key American imports.
Akela Gada with the latest down in Washington. Akela, thank you. With us around the table, Libby Cantrill of PIMCO. Libby, good morning.
Good morning.
August 1st. Are we going to wrap this up, or is that the new July 9th?
Yeah, I mean, look, I think what we've been telling our clients is that we are going to be living with trade policy and tariff policy uncertainty for the duration of this administration. So maybe we get a little bit more clarity. I would agree that 15% is the new 10%, 10% is the new 0%. Kind of the best that a country can hope for, those with trade surpluses, is going to be 10%, and then everything else is going to be higher. I mean, Japan got, I think, arguably a pretty good deal here. But again, if we just take a step back and go back to December, right after the election, and we were just saying we're going to be sitting here and talking about how 15% seems pretty benign on one of our closest allies and trading partners, I don't think anybody would believe it. So I think that the Overton window, if you will, has really been expanded here, kind of shattered in terms of what is acceptable in the markets and in Washington. And again, I think from an economic and markets perspective, we do think this will start having a bite at some point, even though maybe markets are just, willfully ignoring the reality here.
Or are the markets numb? Has Trump basically conditioned them to accept 15% because they're not as the sky-high April 2nd tariffs originally this administration came out with?
Yeah, I mean, I think, what we have been talking to our clients, the sort of like the taco man versus tariff man, this idea of Trump always chickening out. And if you actually look at the tariff level right now, it would not suggest that he is chickening out. Yet, yes, he has softened his most extreme stance. So will the effective average tariff rate go up to 30%? Not likely. But where we think it probably will land is between 15 and 20%. 15 and 20% tariff. I mean, that's not insignificant. So yes, I do think that in some ways, again, this idea of, the Overton window, sort of what's possible in Washington, he's expanded that so much that the market is somewhat desensitized. But we do think this will start having actually real economic effects at some point.
When it comes to these negotiations, I was really struck by the Japanese one because of that $550 billion fund. And I'm still kind of confused about exactly what it is, because the Prime Minister of Japan is talking about that these are basically loan guarantees. And Howard Lutnick, the Commerce Secretary, is saying it's much, much more than that. Almost sounds like a bit of a slush fund. Do you understand what the administration is looking for when it comes to trading partners?
Yeah, I think we are like everybody else is waiting for the details. I mean, I think a couple of things on this. One is that for another country to be funding our industrial policy, that could actually have some implications. So I think there's one of just sort of, is this sort of politically realistic that you're actually relying on another country to actually make investments in things that are important from a national security or from an economic perspective for the country. The other, which is a little bit technical and a little bit wonky, but I think also important, is if the objective for the administration is to reduce the trade deficit, you can't reduce the trade deficit with a country and increase the capital account. Those things are supposed to be offset. So, I think that you're trying to have kind of both ways here. So we'll sort of see what the details are. I think, our suggestion to our clients is just to focus on what we do know, though, which is the 15% tariffs again, that's an increase from the 3% that we had in January.
You have the joy and the opportunity of going around the world and explaining this to everybody. And I'm curious how different the reaction is for people not in the U.S. versus the United States and how they plan to sort of operate around that.
Yeah, I was just saying before the segment that I was in Canada yesterday meeting with some of our large institutional clients. I've been all over the world. We have the benefit of having long-standing relationships with clients, again, outside of the U.S. and inside the U.S. And the perspective is different. I think that some ways there's sort of asymmetry around the information. So I think there's some assumptions that are made that maybe are not necessarily right for our foreign clients. But I think more importantly, our clients were already over-indexed to sort of U.S. equities, to U.S. dollar-based assets coming into this year, right? The sort of the narrative of American exceptionalism, the expectation for just blockbuster growth in the U.S. and sort of languishing growth elsewhere come in January. That obviously has changed. Those expectations have changed. So our clients, in some ways, were already reevaluating some of their dollar-based asset allocation. And I think this probably has accelerated that. Certainly, the tariffs, I think, again, maybe they're impervious to that, maybe a little bit more desensitized. Some of the knocks on the Fed, some of the questions about the strength of the institutions, sort of the political, functionality of Washington. I think those all are still questions front in terms of in their minds.
Sam Zeef of JPMorgan Private Bank was on earlier, and he said initially people just work in the derivatives market to hedge their dollar exposure, but the actual reallocation happens over time. Is that something that you're seeing, too, that there's a lot of reallocation away from dollar-denominated assets in the pipeline that hasn't fully come to the fore yet?
Yeah, I would say with our clients, we are seeing exactly that. We're seeing them this sort of being taken out in the FX market, hedging their dollar-based exposure. Broadly speaking, there was some discussion around the tax bill. There was a Section 899, the revenge tax, which was definitely, I think, would have had some significant implications on actual asset allocation. I think now they are maybe sort of taking a step back and not necessarily divesting from the U.S., but I think sort of maybe hitting a little bit more of the pause button in terms of new allocations to this. But of course, it's different for every client, so I don't want to sort of generalize, but I do think that there is more of just a reevaluation of some of their dollar-based assets.
Libby, it's good to see you. As always, thanks for being here. Libby Cantrill there of PIMCO. To pick up on Libby's earlier point, if you think 15% is chickening out, then you've been played and you don't even realise. Because he's set expectations to the extreme so far that you're willing to accept something that bad. Maybe
he won, right? Because right now the market's accepting it, and the market has essentially said we can live with that. And so the ultimate question is, what would it take? How high is the bar for the market to feel differently?
Up next on the programme, we'll catch up with Ajay, Rajadhyaksha of Barclays, with President Trump planning a rare visit to the Federal Reserve. Plus, we'll catch up with Danny Berger with your morning movers as the Mag 7 kick off with some mixed results. Tesla down 6%, Alphabet up by close to 4%. From New York City, this is Bloomberg. Three days of gains on the S&P 500, the longest daily winning streak of the month so far. Looking to add some weight to it this morning, up by 0.1% on the S&P with 2 hours from the opening bell. Let's get you some morning movers with Danny Berger. Hey, Danny.
Hey, John. We're getting the big tech earnings trickling in. Yesterday after the bell, it was Alphabet that had really strong AI demand. But to keep up with that demand, their capital expenditures, $85 billion, $10 billion more than they had originally estimated. When that number came out, first shares dropped. They reversed, though, really just talking about that strong demand for AI. 3.6% is where we stand. To the downside, there is Tesla this morning. The quarter itself was a difficult one. The worst fall in revenue in over a decade. Free cash flow evaporated, but it was an Elon Musk that tried to frame the company as one in transition from EVs to autonomous driving, saying that in that transition, there'd be a few rough quarters ahead. Shares down 6% this morning. Also heard from IBM after the close yesterday. The focus was on their software unit, and their growth in sales also disappointed. The hope is that AI features, AI tools quantum computing would help lift it up. Unfortunately, the bar was high and the company didn't make it. Management there saying that they would have more AI revenue to come. Evercore, though, skeptical that software sales can continue at pace into the second half. Shares down 6%, John.
Danny, thank you. More from Danny in the next hour. On our radar this morning, one of our top stories, President Donald Trump floating a tariff floor of 15% on U.S. trading partners, saying his so-called reciprocal tariff rates will fall between 15 and 50 percentage points as countries race to make deals before the August 1st deadline.
And the market's accepting it. So right now, if he was looking for something to hold him back, well, he's not getting that from the markets. This is definitely something that is being welcomed as a relief. And I do wonder whether the relief from certainty is enough to overcome what the ramifications of a 15% floor to tariff rates actually means economically.
We've talked about it all morning. We know the rates in some places. Do we fully understand the consequences? So far, we don't. Got to be open-minded about how this plays out. But will growth slow? Will inflation firm? Will the Fed's easing bias be complicated going into next year?
Well, the difficult aspect with this is just on an absolute basis, maybe, right? Just if you look at one side of the equation and then the other, you could understand why there would be a stagflationary tilt to this. But then you overlay that with AI investment, some of the other sort of secular themes, and it becomes very difficult to make that blanket statement, which is the reason why people have been surprised by the resilience of the economic data so far.
Also, the Treasury Secretary said yesterday that if Trump is unhappy, say with a country like Japan, the rate can go back up from 15% to 25%. So how do you even plan for that future, especially when he is a self-described yesterday negotiator junkie? He said a deal junkie. So he constantly wants to be in negotiating mode. So who's to say by August 1st, even if they have these deals done, like with the European Union, which seems to be next in line, that it's going to end?
Libby Cantrill said the same thing of PIMCO just moments ago. Get used to it. We're going to be doing this for the next several years. Let's take a look at Tesla this morning. Shares are lower. The CEO, Elon Musk, warning of, quote, rough quarters ahead, saying the EV maker would be in a transition period for the next year or so. His comments coming after the company posted one of the worst quarters in over a decade.
The more he talked, the more the shares went down. This was a disaster of an earnings release. And some people dismiss all of his earnings release calls, as we heard from Dan Ives. It's just this is what he does. That said, real questions about bringing forward production of the more expensive vehicles, holding off on potentially creating that more affordable kind, making it just basically a stripped down Model Y. Real questions also about his leadership going forward. How much is the onus shifting from a dream stock to one rooted a little bit more in reality?
When it comes to what's going on in terms of also how he's dealing with policy in Washington, not even the personnel issue of no longer being the first buddy and obviously the acrimony between him and the President of the United States, the one big beautiful bill, calling back those EV tax credits, and the CFO yesterday putting the cost of tariffs on the company, saying it increased around $300 million, a third of impact hitting the battery division. Of course, these batteries coming from places like China.
It's real money. Stock is down by close to 6% in the pre-market. Let's talk about the airlines. Southwest cutting its 2025 outlook, expected to take a $1 billion profit hit due to tariff uncertainty. Elsewhere at American Airlines, beating on earnings and reinstating its annual forecast with a wide range of minus 20 to 80 cents per share.
So both of them trying to quantify the potential ramifications from tariffs. You saw Southwest trying to say that they're going to lose as much as $1 billion off its annual pre-tax profit this year. Then you have American coming out, and yes, they have this really wide range, but what's notable is how different their tone is than United and Delta. United, Delta, stability, strength, recovery. Maybe we're underestimating the optimism. American, corporate travel generally flat. Doesn't have much large capex in 2026. Third quarter more difficult with a bigger than expected adjusted loss being expected now in their forecast. Just not the same kind of picture, which speaks to execution, client base, and how much is really baked into the premium versus the rest of the cabin.
You nailed it. Execution. Americans had a problem for a while now. That problem seems to be persisting.
Which is the reason why they're being held to a higher bar and the reason why you're seeing the shares lower, even after reinstating their earnings expectation.
That's the latest on American Airlines this morning. Let's turn to the Federal Reserve. The Trump administration piling the pressure on Fed Chair Jay Powell.
The president said he is not going to fire Chair Powell. It would do Chair Powell a favor, and he would be doing the institution a favor if he did an internal review. This mission creep from the Fed is endangering their independence of monetary policy.
President Trump making a rare visit to the Federal Reserve this afternoon to see the $2.5 billion renovation. Ajay Rajadhyaksha of Barclays writing, concerns about Fed independence persist, but we expect status quo to prevail. Ajay joins us now for more. Ajay, good morning.
Good morning.
This market has shaken off a lot. Threats to Fed independence, trade, tariffs, threats, actual tariffs. Can this economy keep shaking it off?
Yeah, I think as long as you don't get a policy mistake out of Washington on the magnitude of actually trying to fire the Fed chair, which I don't think will happen, I think we are past the worst of it, and we are looking forward to a big boost in growth over the next few quarters.
So this is really important because some people still fear that the worst of the data is ahead of us. What gives you confidence?
The fact that there have been virtually no second-order effects. Now, remember, I agree with your previous guest. Libby made the point that there have been substantial tariffs. If you had told me we are at 2.5% entering the year, we finish at 17, 18, I would have been shaken. But part of the reason I would have been shaken is that because I would have expected business investment to pull back. I would have expected consumer precautionary savings to go up. Fact of the matter is, John, none of those things have happened. And that's to do with if they were going to happen, they were going to happen with the headlines. They were not going to happen when it actually plays out. It's very, very hard for me to see big new second-order effects now, the consumer pulling back hard. And without that, you do not get a lasting, like a recession, a lasting hit to U.S. growth.
Are we measuring the economy correctly? And I ask that because there are pockets that are clearly suffering. And you're seeing that in numbers like from Southwest, where consumers who don't have as much money aren't able to travel as much. But then you have this industrial revolution, this renaissance, this huge investment in AI technology that's generating efficiency and profitability at the biggest and the most powerful companies and individuals. Is this showing up in the data, or is this just changing the way we understand our economy?
I think it's the latter. I think we are measuring it correctly. There's no reason to believe that we've suddenly changed. The fact of the matter is what you said. The United States is two different economies. One is the old economy. We all grew up believing housing is the business cycle, for example. And, housing is struggling with mortgage rates staying where they are. The durable goods sector, you mentioned airlines, they are struggling. Doesn't matter. You have the large tech side and the AI dividends starting to kick in. And I think that matters far more at an index level, at an economy-wide level. The fact that the hyperscalers just never pull back on spending. You might have worried as an importer into the United States about Mexico, Canada, whether I can make my business work or not. Who cares when Google is spending another $85 billion at a macro level?
Well, at the same time, back during the pandemic, it was sort of the revenge of the fiscal world. That was something that John said every morning as we walked in. And it was sort of the reality of trying to get toilet paper, although he had stacked up. I am just wondering whether we're going to end up with revenge of the physical world once more. We're talking about investment in the cloud, in all of this sort of technology that's for companies, the way we think, the way we do work in white-collar businesses. What about the goods and services that have to go over on ships?
I don't think there's going to be a revenge of the physical world. I almost think it's the other way around, meaning that right now we are all focused on LLMs. You put in text and you get out a bunch of information. That is the AI models, and that we think will hit services jobs. The fact of the matter is I think we are 3, 4, 5 years away from the same thing happening where you put in a bunch of text and you have a robot doing subtasks. I'm not kidding. This is not sci-fi. I feel the way I did about NVIDIA 5 years ago. None of us thought it would get as big as it is. But the fact of the matter is, that Moore's law, the fact that things are twice as cheap, every 18 months they're twice as powerful, does work in the semiconductor world. It doesn't work in the physical world. Fusing AI and robotics is powerful, and I almost worry that you're going to have more of the profits continue to go to capital. We always grew up believing, plumbers, you'll always need plumbers. Well, you might not 5, 7, 8 years from now.
What you're saying could ultimately mean the market is okay, but the employment market gets a whole lot worse.
It does, and
are there limits to that?
The limits are put in by society. At some point, there are 70 million knowledge workers in the United States. I've had a person I consider the single best investor of all time make the argument to me that he's looked at this upwards, downwards 5 years from Sunday, and he's telling me that 10 million of these workers will not be needed in 5 to 7 years. He's not saying they won't have jobs. The economic activity that they do now, the value add will be done by machines. We see it in big tech, right? 40% of coding. You realize Microsoft's let go of 20,000 people. They have money coming out of their ears. There's a reason why this is happening. Eventually, society pushes back. It's happened in every technological revolution. But the difference now, John, is that in the past, when you had this, right, we were okay with debtors' prisons. We were okay with child labor. 100 years ago, the transition, we didn't make noise. This time it'll make a lot of noise.
I'll share with you what concerns me, and I'll be open and personal about it. For children of Thatcher and Reagan, I'm highly concerned that if you concentrate capital and wealth in the hands of just a few, that the political movement, the corrective course of action on behalf of the people will be for the state to get a whole lot bigger, to go forward with higher taxes, universal basic income. And for people like me who don't really believe ideologically in that view of the world, that scares the living daylights out of me.
It should, but that is a very real risk. Now, until we get there, you're going to have corporate earnings flatten, for years to come. You're going to have operating margin leverage. And then the other side of it will be society pushing back. It's happened before. I mean, 6 of the 7 big oil majors came out of one company, Standard Oil, remember? So this is not every 15, 20, 50 years, if you have a big technology change, where all the advantages go to capital, which is what is going to happen. I think eventually society will push back. But until it happens, it's actually a very nice ride.
But building on John's point, should we just expect higher deficits then?
No, I think the OBBA and the tariffs from revenues, the total deficit from that is not higher than if just the Trump taxes that were expiring had been extended. And we all thought they would be extended, if nothing else, right? The problem, the reason why the long bond in the United States refuses to come below 5% is not because the OBBA is more profligate, it's because it locks in. It makes it clear that we are not going to go away from 6.5% to 7% deficits, which is where we were this year, last year, for at least 10 more years. You mentioned Rachel Reeves and the conversation from 3 weeks ago. The significant part was not that she got emotional in person. The significant part for me was Labour has a big parliamentary majority and cannot pass a simple change, a small change to the welfare bill. That was the significance of it. There's no political will.
Ajay, appreciate your time. Enjoy the ride in the market right now, seems to be the message, and we'll catch up in 5 years' time.
Cheers.
Ajay, thank you.
Can I just say, yesterday I was speaking with someone who headed employee engagement for artificial intelligence at one of the biggest companies in this country and frankly in the world. And what they were saying is they'd been doing this for 40 years, looking at changes in technology. They have never seen anything like this. Yeah. And it changes every single day. That was a pretty stunning statement.
I hope my fears don't play out. I hope I'm wrong. I think you want freedom and upward mobility, and people might say that sounds super cliche. Look, that's what I believe in, personally. You might believe in something else. I fear what would come down the road if Ajay's view of things plays out.
Especially because you've got agents talking to each other, discussing how to make things better and Xing out the human altogether. And guess what? Humans tend not to be that efficient. We have desires. We want to go to the bathroom. We want to talk with our friends. We want to let our minds wander. AI agents don't have that problem. And so at a certain point, yeah, you've got better efficiency. But if someone's going to be a pain in the neck, why do you need them?
Enjoy the ride. Future's positive. Stocks at all-time highs. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahira. Hey, Yahira.
Hi, John. Staying on artificial intelligence, the Trump administration unveiled its AI action plan meant to boost development in the U.S. by loosening regulations and growing power supplies for data centers. Measures include addressing energy and permitting issues for infrastructure and the promotion of AI exports, as President Trump says the U.S. will lead the world in AI. Meanwhile, Chipotle shares are plunging 11.7% in the pre-market. The company cut its annual outlook for the second time this year, saying sales at established restaurants will be about flat after previously forecasting a low single-digit expansion. Its new honey chicken offering and burrito giveaways failed to bring enough customers through the door. And Goldman Sachs has decided against the second round of performance-based job cuts this year. The Financial Times reporting the bank made the decision following a better-than-expected recovery in investment banking and continued strength in its trading division. That's your Bloomberg Brief. John?
Yahira, thank you. Up next on the program, a new standard for AI.
From this day forward, it'll be a policy of the United States to do whatever it takes to lead the world in artificial intelligence.
Up next, we'll catch up with Chris Caso of Wolfe Research. Live from New York, this is Bloomberg. Minutes from now, an ECB rate decision. 15 minutes after that, so at 8:30 Eastern Time, jobless claims. All of that still to come in the next hour or so. Equity futures positive by 0.1% on the S&P. On the Nasdaq 100, doing okay, up by 1/3. Under surveillance this morning, a new standard for AI.
From this day forward, it'll be a policy of the United States to do whatever it takes to lead the world in artificial intelligence. America is the country that started the AI race. And as President of the United States, I'm here today to declare that America is going to win it. We're going to work hard. We're going to win it.
It's the latest this morning. President Donald Trump signing executive orders to boost AI development in the US. The plan includes loosening regulations and expanding energy supplies for data centers. Bloomberg's Ed Ludlow joined us now for more. Ed, that was quite an event. What stood out for you?
Yeah, it's really a question of what is actionable within the action plan, right? You talked about deregulation, but at all of those pillars of it, basically expediting permitting, both so that mega cap tech, hyperscalers can build data centers faster. But the energy component's really critical. Basically, all of the cabinet members that spoke and the president himself framed this in the context of what China is doing. China moves very fast and aggressively to ramp up its supply of energy, largely through coal-powered power plants, but sourcing electricity nonetheless. And, you know, the executives on the ground and the officials that I spoke to all basically agree that all America wants to do is be able to move faster and now seems more sanguine about exporting technology globally, including to economic adversaries, which is a big change, not just in tone, but in policy position, right, from where we were at the beginning of the year, let alone in the last 4 years.
Ed, who's driving that change, the State Department or the NVIDIA CEO?
Yeah, it was a very interesting moment. I mean, Annmarie and I discussed it, whether Jensen Huang is now the first buddy or not. There's a cautionary tale in that, of course, with Elon Musk about the relationship with the president. But I would also point out something that was missed. The president asked Mr. Zeldin from the EPA to stand up and said that of everyone gathered, he was the most important person in the room, even though he also invited Jensen Huang to have a prompted standing ovation, because it will fall to Mr. Zeldin and the EPA to enact this kind of cutting of red tape and the expedited permitting process that basically underpins all of the big picture pledge that's in the document.
We need the energy. We need tons of it.
You know, kudos to the administration, to be completely honest, for really analyzing what's needed and to understand what the sort of landscape is and to investigate it and highlight it, because from every economic individual who comes on the show, they highlight this as well.
Ed, thank you, sir. Ed Ludlow, down in Washington, D.C. this morning. Chris Caso of Wolfe Research has an outperform rating on NVIDIA with a 170 price target, and he joins us now. Chris, welcome back to the programme. A lot of people come on this programme and act as if it's just winner takes all. This one name takes all. Are there other names that are doing well in this theme as well?
Yeah, and we still think NVIDIA is the best way to play AI because so many of the concerns that were had at the beginning of the year have now gone, and clearly they're the leader. With regard to the other way that we like to play it is with memory as well, because the HBM memory that goes along with AI chips, the NVIDIA chips, the custom chips are a big driver as well. There's a big inflection point coming in 2027 for that, and we think Micron in our coverage is a prime beneficiary of that as well.
Meanwhile, we got this reporting out of the Financial Times today, and I do wonder how much the regulatory problems are going to throw some sand in the gears. That at least $1 billion worth of NVIDIA chips that were of the highest order had been shipped to China in the 3 months after some of the constraints had been put in place by the Trump administration. How concerned are you about some sort of crackdown or additional caps or bans by this administration and how it affects semiconductors?
Well, of course, it was just a couple of weeks ago that the administration reversed the ban on the H20, the chip that had been NVIDIA had been permitted to ship into China. Again, back in April, they stopped that, and now in July, they've actually allowed that again. And we think that's a sensible policy because the chip that is permitted to be sold in China is designed to be equal to what China can do themselves. So the concept there is that you're still restricting China. They can't get the best technology, but yet you're not pushing the Chinese customers to buy local, that you still allow them to buy U.S. technology and NVIDIA. And we think that's the best technology. Now, smuggling is always going to be an issue. People are going to figure out a way of getting it. But, actually in AI, $1 billion is actually a small fraction of what the larger market is right now. So actually $1 billion is not as big of a number in AI these days.
Trump last night described the government's support for AI as a national security priority to prevent allies turning to rival technology, not as a national security priority to prevent our chips going around the world, but for partners to look elsewhere, i.e. China. How do they balance the two?
Well, and there's an important point, too, with regard to China, and that's the restrictions that we have in place in Chinese manufacturing. So Huawei is the Chinese leader in AI, but they're also restricted in where they can manufacture their chips. Huawei can't go to TSMC and manufacture, unlike NVIDIA, unlike AMD. So that already puts China at a disadvantage. In addition, the U.S. companies, and frankly, all the companies, ASML included, are restricted in what they can sell into China. So from a manufacturing standpoint, we already have some restrictions which, kind of constrain what happens in China. But again, I think in terms of promoting U.S. technology, a two-pronged approach is probably the right way, is restricting what can be produced in China and then promoting, the U.S. solutions such as NVIDIA.
With the administration now making this U-turn from April on the H20 NVIDIA chip, what's the new negotiating chip they have in their hands when they sit across from their Chinese counterparts next week?
With regard to the broader trade discussions?
Yeah, do they have something that the Chinese really want when it comes to export controls and semiconductors that they can use as a negotiating tactic?
Well, again, one would be, as I said, the equipment that's used to make the chips. I don't expect that to be the case, and I think that it's still going to be policy that we're still going to restrict what China can, what we can sell to China to make chips internally. So my guess would be that the chips that would be on the table, if you will, would probably be outside of semiconductors in terms of the negotiating.
Hey, Chris, appreciate your time. Thanks for breaking it down. Chris Caso there of Wolfe Research on NVIDIA and a whole lot more. That company, that CEO, is in the driving seat.
He seems to be, as Annmarie said, setting policy at a time when that really is the ultimate American exceptionalism. Just think about it. Who's driving who, given the fact that that is the ultimate driver of so much of the optimism around the U.S. economy?
Stocks at record highs, futures positive. Up next, Tom Kennedy of JPMorgan Asset Management, Pooja Kumra of TD Securities, Nela Richardson of ADP, and Thierry Wizman of Macquarie. Just moments away, an ECB rate decision, and later, jobless claims from New York. The third hour of Bloomberg Surveillance. Up next.
We're looking at the riskier parts of the market. They can't get much better than this.
Technology companies driven by artificial intelligence is going to be where you get your earnings growth this quarter.
On the whole, things are quite nice, but the fact is there are a lot of potholes. The pullback would be healthy.
With continued clarity on tariffs, we've got a calmer market, hopefully.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
OK, so this hour, a busy one. At about 15 minutes' time, an ECB rate decision. 15 minutes after that, jobless claims in America, 8:30 Eastern time. And then later, you'll hear from the ECB President, Christine Lagarde. Into all of that, futures just about positive by 0.1%, coming off all-time highs on the S&P 500. And we add some weight to the Nasdaq. Positive this morning by 0.3.
Futures are dancing to their own music, and it doesn't have to do with tariffs. It has to do with the fact that they don't have to think about tariffs as much because maybe we've got a little bit of certainty. And we've got earnings that have been pretty positive, particularly from some of the Magnificent Six. And I say Magnificent Six because Tesla is the outlier here. But when it comes to AI innovation, that was just doubled down on by Google. And that certainly is helping to fuel what we're seeing this morning.
Earnings decent for most of these players. Will the data hold up? 8:30 Eastern time, jobless claims, 226,000, the estimate in our survey. We're around the 220s at the moment, and we've hung in there. The data's been okay. Will it stay that way through the summer?
What if it does, right? Then does everybody who is pessimistic and talking about the ramifications from tariffs, called chicken littles and rejected, kicked to the curb, said, you're just a big bear, get over yourself, let's get on the bullish train. And how much is it just going to be delayed that much further? And I think that really is the ultimate question. Have we just extended the timeline, or have we suddenly overimposed something that is much more positive on an otherwise pretty negative narrative earlier this year.
I talked about an interesting hour coming up. I left this out. Later on this afternoon, the president visits the Federal Reserve. A tour of HQ.
He's going right to the doorstep of Jay Powell, who he's been job moting for months now. And this really comes down to not this argument that just the Fed, he's annoyed they're not cutting interest rates, but the fact that this administration has been really going after the Federal Reserve for being over budget when it comes to their renovations. And we know that officials were going to take this visit. We didn't know until last night that the president himself was going to join it. This is going to be a lot of theater and a lot of drama.
Theatre, that's the word. Drama, that's another word. Will it actually move this market in any way, shape or form?
It seems like every time President Trump mentions Fed Chair Jay Powell now and calls him stupid, do nothing, too slow, the market's going la, 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 because they have moved on. And we've heard from Scott Bessent, who seems to be much more of a directing hand, saying we're in no hurry to replace him and he doesn't need to step down. A
series of all-time highs in this equity market. This stock market has moved on. Coming up this hour, Tom Kennedy of JPMorgan Asset Management following a fresh record high. Pooja Kumra of TD Securities with an ECB rate decision just around the corner. And Thierry Wizman of Macquarie on the impact of tariffs on global interest rates. We begin this hour with stocks notching a fresh record high. Tom Kennedy of JPMorgan Asset Management writing earnings are surprising to the upside, but the rally is mostly a PE expansion story. Tom joins us now for more. Tom, good morning.
Good morning.
Forward multiple elevated north of 20 has been for a while. Anything to worry about?
I do think there's a statement of pause here, right? We have to see these earnings come through. So far, we're 2 weeks into earnings season. You're seeing surprises to the upside and wide breadth of surprise. So it is a positive in there, but you're pushing up against a limit where how much can the earnings actually deliver for you? I think we've had a great run. I think investors should feel good about that and start to look around and say, are there other things that I should be adding to my portfolio to maybe diversify that exposure?
It's another way of saying you don't think this continues in the second half.
Look, I think we're all in our business, in JPMorgan Asset and Wealth Management. We're in this to be for the long run. So you're going to hear from people like us that consistently say that. But you have to add diversification when you have these great runs there.
What is diversification? I was looking at a note from HSBC that said that you have to re-examine what diversification means, and increasingly it means the euro and gold. Is that how you see it?
I think diversification can have many faces, but to the point I think that they're trying to make is diversification in the pre-COVID era may be different in this era. And when you have a low interest rate environment, bonds become an excellent diversifier, and it's simple. You just add the Barclays Ag to a portfolio. Why do you do that? Well, if you're fighting inflation below 2%, any growth scare means rates come down. But now inflation across the world, whether it be in Europe, whether it be in the US, has inflation upside risk, and you need new diversifiers. So what do they look like? Gold, for sure. Also real assets, things like real estate and infrastructure, because those will nominally reset if inflation surprises you to the upside.
Do you ever get clients saying to you, you've been talking about diversification and you've missed out because ultimately it's been a one-way train up and you have all this discussion about artificial intelligence, it's going to deliver me the world and it's going to really consolidate it into the capital holders. So why are you still telling me this?
Yes, we consistently get that recency argument. But we don't have to have that recency argument as big right now in that we did have a shock. This year we did have a 20% correction. It wasn't, or nearly a 20%. It was very short-lived for sure, but volatility in the market is there. So recency bias doesn't feel as strong. That argument before COVID was even harder to deal with. I have this diversification on income, but rates are so low, and my income stream is so low. I think it was harder then. Now I think clients are more engaged in the diversification conversation.
When you're talking about volatility, I can't think of Liberation Day on April 2nd.
Yeah.
I was there in the Rose Garden. The market started to rally when it was just 10%. Then that big chart came out and then the market started to tank. You say 15% tariffs are positive, apparently. Has Trump changed the psychology of how we view tariffs?
Look, if we sat here on Liberation Day and said we're going to settle at a 15% tariff, I think we would have felt good. But compared to Liberation Day to today, 15% was no one's expectation. The apparently is the stock market seems to really be happy about this. And I think we have to go a little deeper. If Japan is setting the standard for what deals will look like, a 15% tariff is being financed with either equity or debt from Japan. If Europe follows up with that, this is not an isolation or deglobalization story. It's the tariffs are meant to lock in a relationship with specific partners. I think what we're not talking about enough is the Indonesia deal is very interesting in that they'll make a deal, but if goods come through Indonesia and they have China related to it, that has a different tariff rate. Right. All things are circling back to there's new relationships that are being built, and China seems to be left out.
A carrot and stick approach. Do you think we're going to see more deals like Indonesia or more like Japan?
I don't know. They're different economies in that not a lot of goods get routed from China through Japan the way that they do for Indonesia. Vietnam will be interesting how that comes about. But this relationship about what's happening with tariffs, the bigger picture, I think, is the market's coming around to. It's less about the tariff and it's more about how the new era of globalization comes to fruition. And it seems to be less about China and America and more about America and who else.
That's far too nuanced. I think markets just interested in better or worse. And these numbers are better than they were on April 2nd. That's it for me. Now we have to work out the consequences. How well understood are the consequences?
So I agree with you, but I think the way we need to get through that recency bias is, yes, it's better than 25%. But if we look back 2 months ago, no one thought 15%. So as we've navigated through this, what has happened? The economy has held up. Pass-through to consumers has been slow so far. But if we land on a 15% tariff, we will have more meaningful inflationary pass-through. I think nuance is the critical piece of this. It is very nuanced. And the things that I think we know are the connection with China is separating. I think we know that.
Yep.
I think we also know that the American economy is resilient, but yet slowing. So what's the Fed going to do about that? That's going to be, as we head up to the September meeting, will be critical discussion.
Do you think it complicates the easing bias at the Fed? The Fed still has an easing bias.
No, I don't. We've been through this before. In Trump 1.0, you had tariffs and they were able to cut. When you look at the momentum in the labor market right now and the U.S. economy, it is slowing. I don't really see any way around that. You look at labor demand, and when you look at ADP, which is giving you really interesting data, small and medium-sized businesses are contracting their employment. So, and this is a 3 or 4 month trend now. This is critical data I think the Fed will look at. Then you can look at construction spending, last 6 months contracting. And you can also look at what's happening in the real estate market where absorption of industrial capacity for the first time in Q2 was negative. What does that mean? There were more people vacating industrial space than there were adding industrial space. That's the first time since 2010. So the real high value or high productive pieces of the economy are showing you things are slowing. I think the Fed is set up quite well to start on some semblance of cuts, whether that be 100 basis points or so over the next 12 months.
So that's the destination, you think, maybe?
Yeah.
3.25%, 3.5%?
Yep.
Okay, so this raises a question. You said investing in real assets is something of sort of of a diversifier. And I wonder how you can get excited about real estate if the only option for lower rates is a slower economy at a time where affordability is already an issue.
So I think we talk about affordability a lot in the single-family housing unit, and this is true. Take a 3-bedroom home in America. If you want to buy it, it's 50% more expensive than if you rent it. That is a historic spread ever. Commercial real estate owns this rental property, and there is certainly an affordability gap. But you, Lisa, as an individual, get to make a decision. Which one am I going to do? And if prices come down, I still want to own the rental. And if, let's say, the economy grows great, I still can push prices and push rents. The setup for real estate is the asset, commercial real estate, has reset prices over 20%. You can look across the market. Yeah, so on a relative value basis, you could stop there and say, oh, that's a good setup because the prices have already contracted. High interest rates have constricted supply, and yet demand for this product is only going to pick up in that housing formation is still happening. So I think from a commercial real estate rental perspective, you're better off than owning. That favors owners of multifamily properties.
Tom, can I just pick up on this point? You said Trump won, the Fed was able to cut even with tariffs, but that was directed squarely at China. Now it's the entire world. Don't you think that's a little bit too optimistic looking back in the past?
No, I don't think so. I mean, I think we have to take the nuance to this. The tariffs are a negative in of themselves. I agree, because the consumer is going to feel higher prices. But what is the goal of the tariff? I think originally we thought it was just America's going to be an isolationist economy. And if we get more of the Japan deal and the Indonesia deal, that's actually not true. The tariff is meant to maybe level the playing field on the relationship, but now you're getting financing capital that's coming into the economy. The way that the capital and current accounts work in America, it has to work this way. If we're going to import goods, the financing has to come from somewhere. And if it's not going to come from America, it's better to come from somewhere else.
Tom Kennedy of JPMorgan. A lot to think about. We've asked this question a few times. We don't want their exports, but we want their capital. How sustainable is that situation?
Well, it's not necessarily mathematical feasible. So you have to create these sort of instruments to create some mechanism for that to be feasible, where both you are exporting, but you're also getting their investment and how that offsets each other. You know, it's going to be complicated and nuanced.
The ECB decision, about 3 minutes away. We'll get to that ECB decision in just a moment. Let's get you an update on stories elsewhere with your Bloomberg brief. Here's Yahara. Hey, Yahara.
Hi, John. We're just over a week away from President Trump's August 1st trade deadline. Last night, the president said he would set reciprocal tariffs between 15 and 50% for countries who do not make a deal. The U.S. and EU are moving toward an agreement that would set a 15% rate. Trump said the EU can pay a lower rate if it agrees to open up to American businesses. Meanwhile, a check on Tesla shares there are falling 6.2% in the pre-market after the EV maker reported second quarter results that missed already lowered Wall Street expectations. Revenue fell 12%, its sharpest decline in a decade. CEO Elon Musk warned of a few rough quarters ahead as Tesla loses EV incentives here in the U.S. And Treasury Secretary Scott Bessent says he plans to bring up the Microsoft hack with Chinese officials when they meet in Stockholm next week. Cybersecurity firm Securities says the flaw in the tech giant's SharePoint software hit 400 global organizations, including both U.S. nuclear and health agencies. Microsoft blames Chinese state-backed hackers. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes. Up next, Pooja Kumra of TD Securities with an ECB rate decision just around the corner. From New York City, this is Bloomberg. Live from New York City this morning, good morning to you all. After cutting interest rates 200 basis points in the best part of the last 12 months plus, the ECB hits pause. Interest rates unchanged. That decision just dropping 2% on the deposit rate, widely expected, in line with the previous decision.
Yeah, and they're not going to pre-commit to any particular path. They're going to take it meeting by meeting, and they are saying that they are determined to ensure that inflation stabilizes. That said, there are so many questions. Does this mean they're done, or does this mean there's one more? And what will it take for them to really begin cutting rates again?
The news conference 30 minutes away on the ground in Frankfurt. Bloomberg's Lizzie Burden. Lizzie, welcome to the program. Your first takeaway on this decision this morning, and then what to look for with President Lagarde a little bit later.
Look, John, this is exactly what we expected. All but two economists in our survey saw a hold coming because they're waiting for more data, they're waiting for more forecasts, and crucially, they want more clarity on trade. They want to know whether Brussels and Washington can get that trade deal over the line. And indeed, our reporting suggests, as Yahara says, it is just around the corner. But even then, it isn't clear whether there'll be how many rate cuts there'll be from here on out. Berenberg, RBC, for example, saying that you wouldn't need any cuts if they get a 15% deal. But our economists at Bloomberg Economics saying you'd need more cuts in September and December because 15% is higher than 10%, which is what they saw in June, and they saw one more cut then. But you've got to throw on the sectoral levies as well as that. Look, we're half an hour away from that press conference. I am really interested to hear what Lagarde has to say when it comes to the euro. I don't think she's going to be as precise as Luis de Guindos in saying 120 is the level that complicates the disinflation narrative from here. But I really want to hear how humble she is when it comes to talking about how good a position the euro area economy is in. Because last meeting in June, to many, what she said sounded like a victory lap. And this time, if she emphasises the downside risks to growth, many in the market are going to take that as a green light to a September cut.
And also the downside risk to inflation as well, Lizzie, which is something increasingly they've got to think about. There's a line of the statement, it's always there. The Governing Council is not pre-committing to a particular path. But just before that, they say the Governing Council's interest rate decisions will be based on its assessment of the inflation outlook and the risks surrounding it in light of the incoming economic and financial data, as well as the dynamics of underlying inflation and the strength of monetary policy transmission. Just reading between the lines there, Lizzie, what do you think they're getting at?
One of the issues, John, is potential dumping of Chinese goods into the euro area economy. And a lot of that will come down to the talks between China and the EU. The second thing is, as I say, euro strength, up 13% year to date against the dollar. And of course, Christine Lagarde in the press conference isn't going to say that they target the exchange rate, but they will be minding it as a channel to influence disinflation. I don't think, as I say, she'll go as far as pinpointing a level, but the more she comes back to that point, the more the market will be minding it.
Lizzie, appreciate the update. Lizzie Burden there of Bloomberg on the ground in Frankfurt. That news conference about 25 minutes away. That's got to be the focus, hasn't it? The disinflationary shock that could come from excess capacity in China, one. And a euro strength has been building now for a number of months, too.
Right. Both competitive disadvantages for domestic firms. The disinflation coming from China, very interesting at a time where there just was this meeting between European officials and Chinese officials. And there clearly is a resetting, an effort to try to come to some sort of new agreement with this very much in the forefront. How much are they going to bear the brunt of all the goods, the overcapacity that China has to sell?
Ursula von der Leyen is sitting down with Xi Jinping, briefing the press just now, and she's talking about this exactly. We need to see progress on Chinese overcapacity. I have to say, that's music to the ears of Scott Bessent, who continuously talks about this, continuously talks about China just dumping on the world and how they need to start transitioning to a consumption-based economy.
They need to rebalance. And if America's putting up the walls to those exports, the pressure is on Europe big time. We've said this so many times. Who's going to eat it? The Europeans will have to eat it.
And so at some point, if they put up the walls, how much does it have to come in tandem with the United States? I mean, this goes to something that Tom Kennedy was talking about. We talk about the United States being more isolationist as a result of some of these tariffs. Is that true, especially if there is a rearrangement of trade lines and trading partners as a result? And that really does have China very much in the forefront.
To explore some of these issues, Pooja Kumra of TD Securities joins us now for more. Pooja, welcome to the programme. How much of a challenge is euro dollar at 117.50 to this ECB?
I think 120 is a number that's been flagged by quite a few of ECB officials. But I think one thing that we need to note is what is driving the strength in euro. And if it's coming with strong capital flows, which is something that we are also seeing, I think that's why ECB members are not really scared of just concentrating on the negative impact of strong euro on inflation. They are looking at the positivity when it comes to de-dollarization trade and how it's supporting the European economy. And I think that's the kind of message they want to actually focus on rather than the disinflation part of the currency impact.
There's a question about overdumping, overcapacity from China and what that does in terms of inflation. But there's also a question about some of the trade levels that we've seen in terms of tariffs coming from the United States. How much do you expect them to address the ramifications from an inflation standpoint, but also, more importantly, for a downside risk to growth?
I think that's a great question, and that will be the focus for the press conference, whether they are actually focusing on the domestic resilience or the trade wars. When it comes to China wars, I think they are trying to take a step back right now. I think everything is fluid, but a 15% number is not something that should make ECB nervous in terms of the Europe-US tariff. Again, it's very early in the stage in terms of getting a deal, and we know these numbers are very fluid. But at this stage, I think they would address the uncertainties. They will actually give us some template, take us back to the June forecast where they had actually given us the mild and the severe scenario as well as the baseline scenario, which is based on a 10% retaliatory tariff. So at this stage, I think they want to be neutral. And as you suggested, data dependency is the mantra for all central banks right now.
Pooja, I'm struggling to really see the inflationary risks here. We're talking about the disinflation from a stronger currency, the disinflation from China dumping overcapacity on Europe. We're talking about the potential for a contraction in economic growth. Where does the inflation pressure come from?
Yes, that's also a big good question. I think the inflationary impact will only come if EU is ready to retaliate. And I think that's the key risk, because then you will actually see the acceleration in core goods, which is actually absent in terms of inflation in Europe right now. So for us, the inflationary impact is kind of limited, but it's limited to how EU responds to tariff policy. But I think one thing also we could get inflation back to Europe is how this fiscal policy works, right? Germany is going strong with the fiscal reforms. We don't know how it's, at this stage, it's just one of the ingredients towards growth, but does it have an inflationary impact? I know it's a medium-term question, but when it comes to ECB members, they need to put everything together when they are forecasting their inflation.
Pooja, here in the US, we talk a lot about a divided Federal Reserve. They meet next week. There could be some dissent. On this governing council, how united are they?
I would say a bit more than Fed. I think there is general unanimity about that the policy is in a good space, and I think they still are waiting. And I think you can see in terms of general data, we are holding up well. I know France is the weaker spot when it comes to Europe, but other nations are still doing well. So I don't think that there's that much juggle within the committee as we have seen in Fed or even in the case of BOE. So I think making decisions seems much more simpler for ECB. And primarily because disinflation came in very easy for Europe. It wasn't a task as we are seeing in both US and UK.
Pooja Kumra of TD Securities. Pooja, appreciate your time. Thank you. 200 basis points of cuts from the ECB in the last year or so when they hit pause. That word pause, though, they might avoid that word. They might prefer the word skip. They want to be agile, nimble, open-minded about the future. They seem to avoid the word pause, don't they?
Right now, traders are picking up on that, and they are still pricing in about 22 basis points of rate cuts for the remainder of this year. The expectation that sometime in the fall they'll resume it. This is the first pause, or skip, I should say, the preferred rhetoric coming since July of 2024. So a notable departure as they assess the landscape.
What's the landing zone for the ECB? They're at 2 already.
Good question.
What are they coming down to?
Is it 175? What is the bigger risk? And where is the inflationary pressure coming from? Is it truly retaliation, as Pooja was just saying?
You can see this disinflationary shock building from the policy front. I don't know what's going to happen in the future, but that's the direction of travel at the moment.
I'm looking for where the inflation is going to come from. And if it doesn't come from China, it doesn't come from a stronger currency, it doesn't come from reaccelerating growth. The only thing that could potentially be is if some of the industrial investment starts to pick up. But we haven't seen that being particularly inflationary either. So very curious how she's going to answer that question.
A news conference with Christine Lagarde, the ECB president, 20 minutes away. Up next, breaking jobless claims data here stateside. We'll catch up with Nela Richardson of ADP here to react from New York City. This is Bloomberg. The opening bounce about 60 minutes away. Your scores look like this. Equity futures positive by 1/10% on the S&P. 3-day winning run coming into Thursday. It's a series of all-time highs. On the Nasdaq 100, positive by 0.3. The economic data just seconds away. Check out the bond market. 2-year, 10-year and 30-year bond yields look like this. Yields higher by 2 basis points. 440 on 10s, on 2s up a basis point. Just short of 390 at the very long end of the curve. Your 30-year at the moment is up 3 basis points to 496.36. Let's get you some economic data. Let's kick it off with jobless claims. That data hasn't dropped just yet, but the estimate we were looking for was 226. It's out now at 217. The previous week was 221. 217 is the right kind of downside surprise, and jobless claims have just hung in there, haven't they, over the past few weeks?
So anyone looking for the bad news to start showing up in the number of people filing for benefits after losing their jobs, you're not going to find it here. Pretty much across the board, you could see initial claims 4-week moving average moves lowered 224,000 rather than staying at the 220, almost the 230,000 from the prior week. There just is a question here. Are we not seeing something? Has the labor market changed? Right now, the market is seeing, honestly, that resilience feeding into the ongoing strength that so many people are pricing into the equity market.
There are subtle signs, though. Continuing claims are still elevated, and this has been a theme now for a number of weeks, and we've talked about this. If you're without a job in America right now, it's getting harder and harder to get a new one.
I'm glad you mentioned this, because actually continuing claims did go up from the prior week. So exactly counterintuitive to what you had been seeing at the highest right now going back to June 20th. So still not necessarily going through the roof, but still the sense that you're right. It is definitely a stagnant market, and you're not seeing that activity really pick up.
Let's catch up with Ira Jersey of Bloomberg Intelligence. Ira, welcome to the program. Next week, the Federal Reserve will put out a statement. In the first paragraph of that statement reads, the labour market or the economy is solid. They use this word solid. Can they keep referring to it as solid?
Well, I think when you have data like we had this morning, you could certainly make that case. I do think that they'll probably moderate that slightly, just because when you look at the payrolls data, you know, it was good, but it wasn't great. And you do see some of the details make things look not quite as strong as they had been in the recent past. But the job market still is not an impediment to the Federal Reserve keeping rates on hold, right? Like if the Fed really wants to cut rates, they kind of need to hang their hat on something. And it's not yet inflation, and it's not yet the jobs market cracking. So I'm not sure if you could really make the case that the Fed needs to be cutting right now, just given the incoming data.
Governor Waller might make that case next week. He might dissent. Others are saying they'll be on hold all year. Bank of America, Morgan Stanley. We spoke to Mizuho earlier this morning, Kyra. Jordan Rochester said you can price out the cuts in 25 and price more in 26. What matters here is Chairman Powell is going to be replaced. What do you and the team think about that?
Yeah, well, I mean, Chair Powell, one way or the other, is not going to be the chair come next May. I think the question is, does he leave before that, firstly, and secondly, is he going to have continued angst from the administration, where the administration continues to say that rates need to be cut and cut more quickly? But again, like from an economic perspective, that doesn't seem to be the case right now. And I do think that the Fed will probably cut this year, but not until the very end of the year. And that's been our call since February, because the incoming data that we have now, you really need to see it slip over several months for a bulk of the committee to cut. Keep in mind, even if Jay Powell were to leave today, you still have other members of the committee and a bulk of the committee that still thinks that the Fed needs to be on hold for this year, or it will only cut once or twice. So you still have relatively hawkish, compared to what the administration wants, members of the committee overall.
Ira Jersey of Bloomberg Intelligence. Ira, thank you, sir. With us around the table, Nela Richardson of ADP. Nela, good morning.
It's great to be here with you.
It's good to see you. Let's talk about this jobs data. We've heard a lot from a lot of people who say this labour market is no longer a reason to be hawkish. Is it becoming a reason to be dovish?
I think you can't say that this labour market's not in transition if you look at the last 3 months of hiring. They're slowing. It's clear. And so whether hawkish or dovish, the labor market is an issue on the table to consider. And I think when we look at next week, which will be jobs week, we'll see a continuation of a slowing trend. And I'd like to mark that trend with something that you can see clearly in the ADP data. The slowdown isn't coming from goods. It's coming from services. And that is the turnaround in the labor market. It has been that services have held the water for the labor market. It's really the goods sector that's suffered. And with tariffs in play, still, you would think it would be the goods sector that is bringing down the momentum. It's not. It's services, which points to a whole different case study on what's really going on in the U.S. economy.
So talk us through what that case study is in terms of, are we just seeing the cycle shift from goods to services, but goods hiring will pick up significantly? Or does this speak to a broader type of trend?
You know, there's so many megatrends right now. And I like to look at the first 6 months of 2025 and compare it to the first 6 months of 2019 before the pandemic. This was actually inspired by something Jonathan said about getting a pay raise. Because if you look, I thought it was a great question. I wasn't satisfied with my answer, so I went to the data. And it turns out that there hasn't been an increase in new hire average pay in over a year. Wow. $18 it's been. And that's because the supply and demand dynamics have held firm. It's a really balanced labor market. I think it breaks because we're seeing lower supply. The labor force participation rate now is lower than it was 6 years ago. There are fewer people working and looking for work, and that's what's going to keep pay a little bit higher or a little bit more stable for new hires than it was 6 years ago.
So this raises a really good, interesting question. Even if we get numbers that look pretty good on the jobless front, not that many jobless claims, on the job creation front, more than some people would expect. Is there anything about this labor market that's inflationary with wages increasing?
Well, this is a very deep labor market. We talk about whether it's solid. I think of it as deep. Still waters run deep. And what you're seeing is that, yes, if you look at job stayers and job switchers, which we look at all the time at ADP, pay growth is elevated. But when you look at those new hires, they're pretty stagnant. And I also look at the job openings by the U.S. government, which shows 500,000 more jobs now than there were 6 years ago. But the hiring rate, the rate at which employers are hiring is lower, 3.4 in May compared to May 2019, 3.8. There is less urgency to fill those positions. And that's what's leading to this no hire, no fire stasis in the jobs market. I think it breaks because of labor supply issues, not necessarily labor demand issues.
Governor Waller was sitting in your seat last week, and it seemed to really weigh on him. The unemployment rate on recent college grads, 7%. What's going on? Why are they not able to get a job?
Well, I think it bends back to the data we just saw. Continuing claims. It's harder to get a job in this labor market where supply and demand are in balance. And for young people coming out into the market, this is not their older brothers or sisters' labor market. In 2022, they were snatched right up. They have that expectation. Their older sister told them that they were snatched right up, and that was the expectation. It's not that labor market anymore. It's a labor market that requires patience and networking. It's Gen Z. It's going to take a little bit longer. And where these college grads are coming out is what exactly is slowing. Professional businesses, services are slowing down. Finance is slowing down. If they were coming out in construction, I think they would see that kind of snatch up in the labor market, but they're not seeing it now.
Nela, it's great to see you. Thanks for breaking it down. Appreciate it. Nela Richardson there of ADP. Jobless claims are holding on, but the rest of the labour market just starting to crack. Some fragility there starting to brew. Just slowly, but you're seeing it.
Well, you're just seeing just not a lot of motion. In fact, that the ongoing, continuing jobless claims is so high and going higher tells you a lot. What Nela was saying there is fascinating, the idea of what kind of wage growth are we seeing? And you're seeing wage growth actually decelerate in Europe. At what point will that justify in its own right what the Fed decides to do if they decide to cut?
That decision a week away. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara. Hey, Yahara.
Hi, John. President Trump is heading to the Federal Reserve today to tour the construction site he is criticized for cost overruns, as the renovation is estimated to cost $2.5 billion. Trump could use any evidence of mismanagement or fraud related to the renovation as a pretext for removing Powell. Meanwhile, take a look at Alphabet shares. They are rising 3.8% in the pre-market after its second quarter sales beat estimates. The company said it's raising capital spending by $10 billion to $85 billion this year, citing rising demand for cloud and AI services. Google is weaving its flagship AI model Gemini into its product portfolio as it confronts competition from Meta and Microsoft. Meanwhile, American Airlines shares are falling 6.5% in the pre-market. The company reported second quarter earnings that beat analyst estimates, and it reinstated its full year guidance, but it said possible scenarios range from an adjusted loss of 20 cents a share to a profit of as much as 80 cents a share. American also forecasts a third quarter loss exceeding analyst estimates. That's your Bloomberg brief. John?
If you don't guide confidently right now, you get absolutely punished. Yahara, thank you. Saw that earlier this week as well, didn't we?
Yeah, pretty much. That seems to be the way forward. I mean, Texas Instruments, the idea that they talked about, we're not sure if this is just a pull forward. And those shares were down something like, 12% in pre-market trading before the open?
They got hammered. This stock's getting hammered too. Up next, Terry Wizman of Macquarie, plus ECB President Christine Lagarde, her news conference moments away. The opening bell about 47 minutes away. Equity futures unchanged on the S&P. If you check out euro dollar, the euro negative, the dollar stronger. The data in America okay. Jobless claims hold on. The ECB and that news conference just moments away. We can catch up with Terry Wizman of Macquarie. He joins us around a table. Terry, good morning.
Good morning, John.
This from Deutsche Bank just moments ago. Mark Wall, the question is, will this be a short pause or a long pause? How are you thinking about this ECB meeting?
Well, the statement seemed to suggest that the ECB is still very data dependent. But I want to broaden that definition a little bit to suggest that it's not just about the data that's going to come out. There are a lot of crosswinds, obviously, besides the data going on with the EU, and tariffs is that biggest crosswind, right? We don't know what the deal will be between the U.S. and the EU, and I presume that even before any data that emits from that deal will become known to the ECB may have to be forced to make a forward-looking decision based on what that deal is. Now, the ECB has been very plain, I think, especially if you read between the lines. Maybe plain is not the right word, but you can certainly infer from what they've been saying that if the only thing that happened was that the U.S. imposed import tariffs on the EU, and the EU did not retaliate, that would be disinflationary for the EU. It might be inflationary for the US, but disinflationary for the EU. So if we do get those 15% or 20% or maybe even 25% or 30% if there's no deal, I think that the EU will see that, the ECB will see that as disinflationary, and it may compel them to cut again, even if the data is lagging. On the other hand, if there's retaliation, right, well, then it's not as disinflationary for the EU as they may have presumed, and maybe they'll do nothing. So, I have to interpret what she's saying very broadly here to include what's going to happen on the policy front with tariffs. Having said that, I suspect that she's going to reiterate today that the ECB is in a good place, that 2% is neutral. And of course, when you have inflation running at 2%, that implies a real interest rate of 0, effectively, which is probably not that different from the per capita growth rate of the EU. And it feels like the right number.
It's interesting listening to you talk about trade. As that news conference gets underway in just a moment, we'll head over there in a second. You're talking just about the agreement between the EU and the US. And I wonder whether for the Europeans, the more important agreement is between the Chinese and the US. Because if the walls go up here, they've got to eat the Chinese exports.
Right. So there's potentially another source of disinflation in the EU. If the walls do come up here and the Chinese are unable to sell product into the US, obviously they'll be forced to dump their products into the EU. But effectively, it's the same situation as the walls in the U.S. being built up against the EU. If the Europeans can't sell product into the U.S., they're forced to redirect those products into their home economy. That will be disinflationary there. So effectively, anything that builds walls around the U.S. imposes some disinflationary pressure on the rest of the world, almost no matter where you happen to be.
Given all the potential disinflationary forces, is Friedrich Merz going to go down to Frankfurt and try to get Christine Lagarde to talk about her renovations and what this means about why they should cut rates sooner?
No, I don't think so. I think what's interesting about the ECB and the nature of the governance of the ECB, where there is all these countries that are represented, means that it's very, very difficult to impose, for a head of state to impose their will on the governing council. It's a very different structure than we have here, right? You have, and of course, some people complain about that from time to time. They'll say the EU is inertial, in part because you have to get agreement from so many countries to do some things. But in some cases, that becomes a good thing, right? You can't have one head of state doing what he wants and imposing his will on a presumably autonomous agency.
The Treasury Secretary said it. They've got a collective action problem. That's what he said to you just yesterday. Thierry Wizman of Macquarie. Thierry, thank you, sir.
My pleasure.
The news conference in Frankfurt is underway. The pause has started. How long will that pause be after cutting interest rates by 200 basis points in a little more than 12 months? Let's take a listen.